Well, today participants share more of their experiences and lessons, including lessons from the government, both national and county governments in Kenya, in unlocking private sector investment. We also hear from financial institutions on their experiences, successes, and challenges in targeting underserved groups, and they share that platform with some of these targeted enterprises. Plus, we have Kenya Investment Mechanism's business advisory service providers and partners sharing lessons on alternative models for long-term capital mobilization. And there's more as well. We're looking forward to an exciting afternoon. I'm Hussein Mohammed, your moderator for the day, and I'm with my colleague, Yusuf Ibrahim.
Thank you very much, Hussein Mohammed, for that amazing introduction. Of course, we are all looking forward to today's proceedings after enjoying yesterday's discussion. Yes, my name is Yusuf Ibrahim. I'm also a journalist by profession, and I'm here to learn. Learn from the experts here. We have those who have financial backgrounds. We have those who are experts when it comes to matters agriculture. And if I can recall my primary school teacher, she used to tell us that agriculture is the backbone of Kenya's economy. I think that is still the case because it contributes to more than 70% of our GDP, supporting more than 90% of Kenya's workforce. So, of course, we're looking forward to this event. So, as far as ground rules are concerned, especially to the Zoom audiences, the people watching us via Zoom, you are all encouraged to participate. Please feel free to make the Q&A box your friend. If you have any question, if you have any burning issue, please shoot them there, and we're going to make sure that most of your questions are addressed. And when asking your question, please identify yourself. I think it's polite to do that. Please type your name and the organization you represent so that we get to know you. And then if you want to ask for any clarification whatsoever, make the chat box your friend. We have our people here who are going to monitor that. And above all, focus on the problem, not the person. We might have differences in opinion and everything, but focus on the discussion first before you talk about anybody else. And of course, be open to hearing other people's opinion. Now, there are those who might not join us for one reason or another, so we don't want them to miss out as far as our social media engagement is concerned. So the hashtag that we're supposed to use, especially on Twitter, is hashtag USAID Kim Learning Event. I'm sure it's somewhere there on your screen. So if you have any contribution, any comments, any suggestion, not necessarily a question, please post them. But for it to gain traction online, make sure you use the hashtag USAID in caps, Kim in caps, Learning Event. And we're going to go through some of your comments here. Once again, we want this session to be very interactive. That is why we have an opinion poll question for you. And we are asking you, are financial institutions innovative to serve all market systems? Are financial institutions innovative to serve all market systems? This is a very simple yes or no answer. Feel free to answer them. And of course, this is going to set the theme for our discussion today. And I'm going to definitely read out the poll results later on in the program. Back to you, Hussein, for now.
Thank you, Yusuf. Let's go to the program now. Our first session today is on lessons from government in unlocking private sector investment. We have 3 speakers for this. As I said earlier, both national and county government, and also there will also be a keynote address. We'll start with Ronald Inyangala, who is the Deputy Director, Financial and Sectoral Affairs at the National Treasury. He works closely with financial sector regulators in Kenya towards the achievement of financial access and inclusion, efficiency and stability, and has extensive experience in public service for over 24 years. He's previously worked for the Ministry of East Africa Community, the Ministry of Trade and Commerce, and the Ministry of Education. Ronald.
Thank you, Hussein. Thank you, everyone joining us. Good morning, good afternoon. I must start by appreciating the Kenya Investment Mechanism for organizing this event and for inviting us as national government. I'll share with us the role of government in unlocking private capital, the case of the Kenya Credit Guarantee Scheme for our MSMEs. Our vision at this scheme is to be a world-class credit guarantor for MSMEs in this country. The government has been in the business of mobilizing resources from private sector. The guarantee scheme is one such initiative. We have other initiatives in the same line, which include the Kenya Mortgage Refinance Company and various infrastructure projects that we know. The objectives for our scheme is for both the national economy, which aims at improving and stimulating our national economy by encouraging additional lending to MSMEs, thus increasing investment opportunities for our MSMEs. We're also looking at facilitating MSMEs, allowing them to get credit from our banks. And then, of course, we also want to improve the business environment around this area. Why are we focusing on the MSMEs? We have a reason. The KNBS data of 2016 indicate to us that MSMEs employ 14.9 million persons, accounting for 34% of our GDP and creating 91% of all new jobs. What challenges do they face? They face a number of challenges, these MSMEs. One of them is that they all die, most of them die in their 4th birthday. They have shortage of operating capital, they have challenges with the collateral, and therefore are not able to get enough credit from the banks. They are perceived to be risk. Lending institutions are not likely to lend to them under the current conditions. If they go to the bank, they get high collateral in terms of their collateral, and the credit applied for are up to about 240. And most of them will complain of insufficient collateral and, of course, looked at as being very risky. So they are denied credit, they have short repayment period, high interest rates, and, of course, inadequate credit. When the same statistics looked at the MSMEs, why do they receive less credit? The main reasons were collateral, high interest rate, and lending ceiling for the banks. From the banking institution and the financial institution, they were the same reasons that were perceived to be the reason for them getting inadequate credit: lack of collateral, high interest rates, and lending ceilings. So the guarantee scheme comes in as one of the ways we want to unlock this sector. And why the guarantee scheme? The focus at the center is the MSME. And the issue is we would like the financial institutions to relax some or all of the conditions that are being used to lend to this sector, so that at the end of the day, the guarantee scheme provides a backing to be able to support these MSMEs. The guarantee scheme is set up as a long-term government policy agenda. Within the Vision 2030, this project has been there. And we must thank USAID, working together with the National Economic Council in 2012. They worked on a book about this guarantee scheme, and that work is still supporting us to be able to do what we are doing. We also have economic gains for the MSMEs. When we support them, they are likely to grow their businesses. And then, of course, we want to address market failures that may be around this, ensure MSMEs that are youth, women-owned, are also able to get credit, and also the marginalized are also able to get credit. For the government, I've already said we want to leverage on private sector resources. Is also our Vision 2030. For the banks, we are looking at additional income from the guaranteed loans and dividends. We are just not developing the MSMEs, but we're also looking at the banks. We're also looking at recognition of the guarantee in the loan provisioning as per the prudential guidelines, so that this guarantee has a meaning to the bank. For our MSMEs, we want to see them getting better quality products from the banks and incentivizing registration of the MSMEs and also being able to build their capacity. What does the scheme we are implementing look like? How does it look like, the current one? The current scheme is a risk-sharing scheme of 50-50. In other words, when we are in the market and participating institutions, is a sharing arrangement of 50-50 pari passu. But the government exposure is up to 25%. The maximum loan amount you can get from this scheme is 5 million shillings. Interest rates, we did not want to interfere with the market. We said market rates, but with that discount from the lender. Term repayment is about 3 years. And of course, we are also saying there are no prepayment penalties. We are also asking for grace period. And of course, we are also asking for negotiation with the bank on the issues of collateral. How does it work? The qualifying MSME will walk to the bank in a normal way. He will be evaluated in the normal way. The PFI will register the credit under the scheme. The PFI will continue to follow the credit in the normal way they do to any other facility and report to us on a monthly basis. How is it managed? We have a steering committee chaired by our PS National Treasury. In the steering committee, we have the PS industry, we have Attorney General, we have Governor, and 3 independent. The PS National Treasury is the administrator, and the scheme is managed by our staff with a scheme manager, whom I am this time. The legal framework for the guarantee scheme, the key takeaways. Number 1 are the powers of the National Treasury CS. Basically, in the law, he is the guarantor. So in a way to do this, he has formed an institution that does the guarantee. In terms of the reports, it's expected that the CS will submit reports to the National Assembly every once in a year, but also, if requested, within 7 days. Who are the eligible MSMEs? They must be registered, they must be taxpayers, they must be registered with the county government, been operating for 2 years, and credit-worthy. Where are we in terms of implementation? The initial steps have been done. We conducted a feasibility study supported by FSD Kenya. In 2010, we were able to review the law and allow for this to be done under the PFM Act. We have developed regulations. We have 39 banks that expressed interest, and 7 banks were taken on board. They include ABSA, Credit Bank, Cooperative Bank, Diamond Trust Bank, KCB, and NCBA, and Stanbic. The scheme was launched on 8th of December 2020. The National Treasury has appointed an interim scheme manager and staff. We have a steering committee fully constituted. We did a midterm review of the scheme on 18th of August 2021 and did a training of the 7 banks just a week ago. Let me now speak about the numbers. What are the numbers saying? Where are we in terms of numbers? We have issued 501 loans amounting to 1.03 billion. This is where we can say we have mobilized private capital from the PFIs. Already, MSMEs from 40 counties have benefited, representing 85% of coverage in the country. MSMEs from 11 sectors are also benefiting. Of course, both micro, small, and medium are also benefiting. But also of interest to us are the women. They are also benefiting from this. Key performance indicators. The loan size range from 75,000 shillings to 5 million, with an average loan size of 2 million. Interest rate range from 9% to 17%. Of course, the loan has been, of course, up to 36 months, but the average has been 25 months. I've already said that both micro, medium, and small are benefiting. The trend for the scheme is on a growth trajectory. We've been growing. April was our best month. Then May and June, we went down a bit, but the growth has also picked up again. We have the report of September, and it reveals some growth also going on. I talked about the sectors, and I can show you the sectors that we are talking about is trade, building and construction, transport and communication. But of course, trade is still at higher than we expect. We want other sectors to come up. In terms of nationwide distribution, you can see we are doing 40 counties. Of course, Nairobi with the highest, but of course, we are in 40 counties. The report of September, I have been told we are now in 41 counties that we are doing this. What are the next steps in this? It's important for us to hear the next steps. We are looking at possibly doing sensitization to raise awareness of the scheme, but also to reduce misinformation about the operation of the scheme. In other words, we want to do targeted awareness. We're also looking at onboarding additional banks so that we have more banks on board. We are also mobilizing more guarantee funds from development partners. Of course, we shall do an evaluation and selection of the banks. We also want to transit to a sustainable model of the credit guarantee scheme. The current one is being operated under the National Treasury, but we are looking forward to do this under a bigger scheme that will be formed. I would like to end with this nice story. For us, each MSME represents a success to us. And I must say, the other day we were having a training with the 7 banks. There was a very moving story from one of the banks where an old man, 51 years old, had never received credit from a banking institution. He walked there, he didn't have sufficient collateral, and the bank evaluated the borrower, and the borrower was given money. The loan is performing pretty well. For us, that is like the starfish boy. An MSME picked every MSME at once and growing and growing, growing. Thank you very much. Thank you for listening to me.
Thank you very much, Ronald Iangala, for that lucid and informative presentation. We all want to be that boy as well, because we've actually benefited from that presentation. I know one or two things as far as credit guarantee design is concerned, credit guarantee scheme is concerned, and of course the legal framework for guarantees. Thank you very much, Ronald. We've heard from Ronald. Of course, he is the National Treasury Credit Guarantee Scheme Manager. So I think it will be fair if we also hear one or two things from the county government. And ladies and gentlemen, let me welcome on stage Elizabeth Asichi, who's the acting CEO, Kakamega County Investment and Development Agency. Elizabeth, karibu.
Thank you very much. Good afternoon, good morning from wherever you are listening to us. I want to thank you so much, especially Kenya Investment Mechanism, for making this happen. I'm not just here to represent Kakamega County Investment and Development Agency. I believe I'm representing the face of counties outside there and what they are doing to unlock investment potential. As I've said, my name is Elizabeth, and today I want to speak about what we are doing to unlock private sector investment and the lessons that we have learned since the beginning of devolution, the mistakes that we have made, and what we have learned from them and how we can improve. So before I say much about what I'm talking about, I just want to just give you a brief introduction of where I'm coming from. Kakamega County Investment and Development Agency, who we are established by an act of the County Assembly of Kakamega to provide for establishment of a legal and institutional framework for promotion and coordination of investments across several departments. Actually, our mission and vision is related to investment. We want to be the hub of choice for investment in Kenya, and our mission is to attract, promote, and facilitate investments within the county government of Kakamega. Our mandate as an investment unit, we have been given that by the law that created us, is to hold property and assets on behalf of the county government. We undertake investments on behalf of the county government of Kakamega for the purpose of generating revenue. We also identify strategic investment opportunities for the benefit of the county. We promote economic growth and also advise the county government on investment opportunities that they can be able to undertake. Our work also involves assisting and facilitating investors and enterprises to establish investments in the county. What is our strategic role in unlocking private sector investment? We know that economic diversification holds the key to unlocking more investment and achieving sustainable development goals. So higher investment inflows could be realized through several sectors, like you can look at agriculture and livestock. Most of our economies are agricultural based. Like Kakamega County, 70% of the population is employed by that sector. Counties can only be transformed as emerging economies by increasing the role of the private sector in the economy, and that is possible through collaboration with partners so that we can improve our policies and make them all-inclusive. So attracting additional investment through financing of the private sector in agriculture through promotion of value addition and agro-processing will help overcome food security and challenges. Now, how do we do it? I want to take the case of how we do it in Kakamega County to help the private sector unlock investment potential. Through the County Assembly of Kakamega, the county government has enacted laws that have created special purpose vehicles to create legal and institutional framework to improve strategic partnership and engagement with private entities so that we can improve investment. Now, we have several SPVs in Kakamega, starting from the agency that I work with, Kakamega County Investment Agency, whose mandate is to attract, promote, and facilitate investment within Kakamega through creation of strategic partnership. Also, Kakamega Dairy Development Corporation is an SPV which has been created by the county government to promote dairy development strategies in Kakamega County and manage smart farms for improved revenue generation. We also have the Kakamega County Microfinance Corporation. This corporation, I want to talk something about it because we started just immediately after the first term of the devolution, where we were lending out to the small enterprises. And the first time, through the lending, we have learned several lessons that I'm going to talk about. When we give loans to MSMEs, or the small, medium enterprises, many times as counties we feel that we are trying to promote the local mwananchi to come up, the local business person to come up, so that they can be able to have a stake in the county's economy. But in the process, we made a few mistakes. The first time, we found that when we gave out our investments, we gave them out for free. And there's absolutely nothing that we got in return. So we decided to look at what can we do differently so that this time when we give out investment in form of seed capital or any other kind of help that we want to give outside there as government, we get returns back and we have something to show. So currently, under the agricultural sector, instead of giving fertilizer for free, we give subsidized fertilizer, where the farmer also contributes 50%. We give fish feed at a subsidized price. We give fingerlings and one-day-old chicks at a fee that is currently moderated, such that the person who is taking this as an investment has put in some money. So he will feel that he has a commitment to take care of this investment that he has been given. Another lesson that we learned is that it is very important to come up with policies, especially when you are creating or starting some of these investments. Currently, we are collaborating with Kenya Investment Mechanism so that we can make sure that our policies are all inclusive. It is very difficult when you go and start a project, then in the process you realize that there's an issue that you did not include in the policy, that probably if you would have widened the consultation, it would have been more inclusive. Another example is our One Cow Initiative program, where we were giving out in-calf heifers. The first time we were giving those in-calf heifers to members of the public who were vulnerable, only to realize that they could not be able to take care of these cows. So at the end of the day, we learned that we have to give to people who are at least able to take care of it so that we can be able to realize some investment in return. So how do we unlock investment then for the private sector? The first way is strategy development. Currently, we urge counties to come up with investment promotion strategies, resource mobilization strategies, such that we are able not just to look at either one pool or relying on the exchequer, but there's a lot of money outside there in the private sector that government also needs to tap in. We know very well that government is not good in doing business, and the private sector is the best in doing business. So for strategy development, it is good to be all-inclusive. You get in touch with the stakeholders and do stakeholder engagement forums. As I give an example of how we do stakeholder engagement forums, like tomorrow on Thursday and Friday, His Excellency the Governor, Wycliffe Oparanya, the Governor for Kakamega County, will be doing his scorecard with the members of the public, where we all present what we have done. And in that process, we get feedback from the public on how we are supposed to improve the programs, and we capture them in the next program. So stakeholder engagement is very, very important. Publicity. If you want to be an investment destination, how can you be an investment destination without marketing yourself as an investment destination. Currently, we have a county website, a county investment website indicating all the investment opportunities that we are having in Kakamega County. As counties, we also need to have incentives that will attract the private sector to say, instead of going to Nakuru or instead of going to Kakamega, let me go to Bungoma. What is that you're giving out to this investor to attract him or her to come to your county? Policy creation. Create the policies. Make sure you partner with relevant bodies and mobilize capital through private sector. So far, what are our achievements in the areas of private sector engagement? We have a fish factory which is currently operational in Lurambi, and that has really encouraged the growth of the aquaculture sector in Kakamega, where farmers have even increased production of fish. We have also constructed the dairy plant in Malava, which is actually almost complete. And we are still looking for investors to come and operationalize. So we still call on the private sector outside there, but Kakamega has a lot to offer so that we can be able to make sure that our economy grows. Thank you so much.
Thank you very much, Elizabeth. I think she deserves another round of applause. It's always good to see women in leadership. Thank you very much, Elizabeth. And clearly, she has indicated that Kakamega County has a lot to offer. And actually, we've learned a lot as far as how governments are supposed to unlock, investment for private sector. She has listed a number of issues there. But again, if you're just joining us, we just had an opinion poll question earlier, and we'd like you to comment a yes or a no, or respond by clicking the yes or no button. And this is what we did ask you earlier: are financial institutions innovative to serve all market system? This will come in handy as far as giving us pulse of how your reaction will look like. Now, ladies and gentlemen, at this juncture, I'm sure you are ready for our keynote address. And this gives me the pleasure to invite Mr. Benson Kimethi. He's from USAID. He's the manager for the Kenya Investment Mechanism Program. And Benson is going to invite our keynote speaker for today. Benson.
Thank you so much, Ibrahim. And Hussein, just say, one of these days will be as eloquent as you guys. Good afternoon, everyone. Just talking very briefly after Elizabeth. As Elizabeth, we are very proud of you in Kakamega. You are a very good example to other county governments we are partnering with. So let me now officially, my remarks will be very short because I want to introduce the keynote speaker. So again, Roger and team, Kenya Investment Mechanism, thank you very much for having me this afternoon. I want to start by recognizing, firstly, the presence of government officials, that is Ronald from the National Treasury, county governments, Elizabeth from Kakamega, and Rollins from Makueni government, and all other USAID partners, private sector partners. So in a nutshell, I would like to say that unlocking private sector-led investments, growth is contingent on the government's ability to establish a regulatory and institutional framework that enables local and foreign firms to invest, form and grow, both domestically and internationally. These are the key focus areas of Kenya Investment Mechanism. A government-led policies and regulations play a decisive role in stimulating business activity. Again, government-led investment promotion and facilitation to attract new investors and retain existing ones, especially in key sectors such as agriculture. Secondly, allow me to highlight the Makueni Fruit Processing Factory that Makueni County established using its own funds to stabilize fruit prices. And by doing that, they achieved another 3 objectives. Objective 1, which was met, was local farmers got the opportunity to generate own incomes. 2, They managed to train farmers on new technologies. And lastly, there were employment opportunities for the community, especially for women and youth. Why I single out this one is for one reason. After the Makueni fruit factory operated for a while, it required county funds to sustain it. And the government realized this was not very sustainable. So what did they do to address this challenge? Because Makueni County is working with USAID, Kenya Investment Mechanism, to help facilitate policy reforms, efforts to remove investment barriers, and create an enabling environment that unlocks private sector financing for target value chains in the agriculture sector. So, Kenya Investment Mechanism experts, with the officials from the county government and especially from the Ministry of Trade and the management of the factory, worked together and came up with a proposal for alternative ownership structure. And the idea here was to open room and doors and windows, if possible, for private investors. This is a classic good example of how government or a government can engage various stakeholders and ultimately find a collaborative solution that builds a stronger enabling environment for business. And we've just had Kakamega taking the same path and route. Thirdly, and in conclusion, by supporting the implementation of transparent, inclusive, predictable, and efficient policies and regulatory framework and practices, governments can help unlock the potential of private sector. They can help incentivize farms and invest, compete, and grow, which creates very much needed productive and decent jobs, again for the youth and women especially. So His Excellency the Governor of Makueni and the Trade Ministry leadership under Waziri Rollins, who will be talking to you briefly, is an excellent example of the public sector leadership, how private sector leadership can bring together public and private sector actors for sustainable development in the agriculture sector. So without further ado, I give you Waziri Lawrence Zunga, representing His Excellency Professor Kibwana, to address you going forward. Over to you.
Good afternoon and good morning, our viewers where they are. My name is Lawrence Zunga, the County Executive Committee member in charge of not only trade, but industry, marketing, tourism, and cooperatives development within the County of Makueni government. When Ben was here, I thought he had already started giving the keynote speech. But thank you, Brother Ben. Allow me now to give the keynote speech on behalf of the Governor of Makueni County, and my Governor, His Excellency Professor Kibwana. Ladies and gentlemen, I am pleased to join you, to join this USAID's Kenya Investment Mechanism learning event. I am honored to offer the keynote address. His Excellency Professor Kibwana, the Governor of Makueni County, would have loved to be here with us today. In fact, he will be the one giving the keynote speech. But he could not make it due to work-related travel overseas. Please receive his greetings and wishes for a great learning event. I want to sincerely thank USAID and the Kenya Investment Mechanism for inviting me to this event. I recognize the presence of government officials, including the ones from the National Treasury and the county governments, such as Kakamega and all others who are here. Ladies and gentlemen, in 2010, Kenyans voted to decentralize government, ushering in a new era of leadership with 47 governors and their teams taking reins of our power in newly created counties. County governments negotiated a working relationship with the national government in terms of power and revenue sharing, and have encountered political, physical, and administrative challenges in the delivery of services to Kenyans. As new entities, county governments lacked the capacity, knowledge, and resources to effectively deliver the dividend of shared prosperity, enhanced delivery of vital services, and improved management of public resources. The idea behind the decentralization of government into devolved units was a noble one. Its main intent was to ensure that every Kenyan citizen can have an equal chance at living a productive quality life. The devolved function of government was envisioned to enhance equitable distribution of wealth and increase access to social amenities, which are central to our collective goal of poverty and reduction. The national government's Big Four agenda was mooted as a roadmap to achieve these things much sooner and in a more sustainable and impactful way. However, there seems to be a disconnect between the national vision and the county's operational framework that could potentially compromise the realization of the set economic goals. It is possible that this tension arises out of the county's need to raise its own revenue to supplement that from the national government and everyday reality of counties' own economic and social gaps. So we find ourselves in the current situations where very few counties can be said to have figured out how to turn their natural resources into sustainable revenue generation resources. Additionally, out of 47 counties, very few, may be even less than 5, have come up with tailor-made economic solutions that supplement social welfare needs of their citizens. The question then becomes, how can we move from having just a handful of counties as outstanding examples on home-made economic solutions to making it a norm across the country? Of paramount importance is the need to attract long-term sustainable investments into counties. One way to do this is through infrastructure development. Counties need to send a strong message to investors that business can be conducted seamlessly and effectively within their borders, especially in industrial towns. When investors perceive an environment to be handle-free, it is easy for them to plan long-term investments, becoming development partners, or who supplement the county government's efforts. To make matters worse, many counties are resorting to charging exorbitant land rates in regions where infrastructural investments are yet to be done. And this becomes a huge deterrent to the current and potential investors. Establishing a regulatory and institutional framework that enables productive local and foreign firms to invest form and grow, both domestically and internationally, and non-viable farms to exist so resources are allocated efficiently within and across sectors is another sure way of unlocking sector-led growth in our counties. You all know that government policies and regulations play a decisive role in stimulating business activity and enhancing market contestability. Within an overarching strategy for improving the investment environment, investment promotion and facilitation can be or can help to increase both domestic and foreign investment and to enhance their contribution to county and national economic development. Investment promotion and facilitation are a means to attract new investors and retain existing ones, especially in key sectors such as agriculture. We are in this COVID pandemic crisis, and we are all talking about economic recovery. I find finance to have a critical role to play in ensuring a truly sustainable recovery from the COVID-19 crisis that will create better and greener jobs, boost income, and lead to more sustainable and resilient growth. Investment will recover when the economy recovers. But we should set the bar high and support the recovery more actively by making structural changes. We can do that by ensuring that the public and the private sector work together. With the private sector mobilizing the necessary investment, while the public sector assures the right enabling environment. Government should provide smart, not burdensome regulation and a stable regulatory environment, as well as guarantee the rule of law and a level playing ground. In Makueni, we established the Makueni Fruit Processing Factory to stabilize fruit prices, provide local farmers with sustainable channels to generate income, train farmers on new technologies and processes, and create employment opportunities for the community members. As we continue to roll out our plan for the factory, the planned operational expansion was constrained by financial reliance on the county government money. We had already invested $10 million to establish the plant, and we were keen to get a return on investment before putting more money. It is at this point we realized we needed to change tact and seek private sector and development partners' collaboration. We then approached USAID Kenya investment through Kenya investment mechanism to help facilitate policy reform efforts and to remove investment barriers, as well as create an enabling environment that unlocks private sector financing for this factory and other value chains in the agriculture sector. The collaboration started with first addressing the sole ownership of the factory by the government. I was impressed by how Kenya investment mechanism brought together the county's agriculture and trade departments, the fruit factory management, and the technical experts to analyze the processing plant's ownership structure. The analysis led to proposed alternative ownership structures for consideration. This was a demonstration to us as a government how engaging various stakeholders and timely leads to a grounded solution. Today, this fruit factory is an attractive investment opportunity where private investors can put in their money and the government can assure a conducive business environment for these investors to get return of their investments. May I emphasize that by supporting the implementation of transparent, inclusive, predictable, and efficient policies and regulatory practices, governments will unlock potential for developing the private sector and incentivize firms to invest, compete, and grow, which in turn creates productive jobs. In Makueni, we have the Makueni County Investment Act 2021 that Kenya Investment Mechanism supported us in developing. The law gives the county the authority to engage in investments and promotion. We have also formed the Makueni County Commercial and Development Corporation, which provides support services to investors, including permits and licenses. These changes and policies will support additional investment in the Karamba Fruit Processing Factory, as well as other county investments in dairy and the pulses, or what we call the cereals. I see this as being extremely important for creating an enabling environment for investment promotion and regulation in the county, and will form a precedent that other counties can learn from going forward. Finally, ladies and gentlemen, let me conclude by saying that what you said through Kenya Investment Mechanism is doing by hosting a learning event where partners can share experiences is exactly what we need to foster as a sustainable, inclusive growth in our counties and in the economy at large. I look forward to hearing the experiences of everyone lined up for this event. Let's be open to learn and learn, relearn, as this is a basis for adopting the best strategies for growth. Thank you very much. May God bless you.
That was Mr. Lawrence Nzunga giving us his keynote address. Of course, he's from Makueni, he's the CSC, or the Minister for Trade, Industry, Marketing, Tourism, and Cooperative Development. And actually, we see why Makueni County is a very good example, among all the other counties. Of course, with all due respect to the other counties. Thank you very much, Lawrence. Now, ladies and gentlemen, yesterday we did ask you a very interesting question as far as financial institutions is concerned. We asked you whether financial institutions sufficiently support smallholder farmers, and a whopping 83% of you said no. So today's conversation is going actually to get straight into that. Basically, we're going to tell you what Kenya Investment Mechanism has done as far as collaborating with different financial institutions is concerned. But at the same time, this next session, which is all about targeted financial products for underserved groups, is going to tell you more about, it's all about sharing lessons from selected financial institutions on the key success factors and the business case for targeting the underserved groups. So let's be very keen on this very next session. And I'm now going to leave you in the safe hands of none other than the moderator of the day. That is Anne Mwenje, Financial Institutions Director. Anne is a corporate banker, transformation and financial coach. She has held leadership roles in banking and finance industry for 10 plus years. She spent the majority of her career in commercial banking, where she helped businesses with their financing needs. She was the Associate Director, Commercial Clients at Standard Chartered, Assistant Vice President, Commercial Clients at Habib Bank, AJ Zurich. Clearly, she has a very well detailed portfolio there, and Anne is going to take this conversation further in our second session of the day. Anne, karibu.
Thank you very much, Yusuf, for that wonderful introduction. Good afternoon and good morning for all our participants, even our live audience. Thank you for joining us today. This is our second day, but this is our first panel discussion where we'll be looking at targeted financial products for underserved groups. And in this session, we'll be learning from our partner financial institutions on what they have done well in terms of successes, their challenges, and their risk mitigations to lending to the underserved groups. And to help me with this discussion will be three amazing partners, and you will hear their stories. It's also good to remember that yesterday our chief of party, Roger, shared with us that 33% of our GDP comes from agriculture. However, lending to agriculture is only 4%. So all of these amazing panelists will share with us what they have done in terms of lending to agriculture, what they have also done in terms of lending to the underserved, and that's it can be women, youth, people living with disabilities. So please join us and ask us many questions and make it as interactive as you can. Our first panelist on stage is Mr. Anton Wambura. Mr. Anton Wambura is the director, he's the director Crescent Takaful, and he will be, just a small change, we will be having Charles Kioko, who is the CEO of GDC Sacco. Charles Kioko has a lot of experience, especially within the cooperative sector, and he's the CEO of Githunguri Dairy and Community Sacco, and he's responsible for the Sacco, and GDC Sacco is a tier 2 licensed deposit taking Sacco, and it is based in Githunguri. We have he'll tell us his plans of expansion because he has very many branches in Kiambu and in Nakuru. And he's also very committed to this sector, and he's a major scholar, and he has very many published works. Thank you and welcome, Charles Kioko.
Thank you so much, Han, for such an elaborate introduction. I don't need to belabor more on that. My name is Charles Kioko. As I said, I actually serve the underprivileged or the underserved. These are the members who commercial banks have left out. So as a SACCO, I've taken them over so that I can provide financial solutions to them because from the mainstream commercial banks, they may not be able to get such services. So I stand a better chance of actually giving out real-life experiences of working with farmers in Githunguri sub-county of Kiambu. And actually, when the name Githunguri is mentioned, everybody knows that Githunguri is the dairy capital of Kenya. So the name Githunguri does not go without the mention of dairy farming. So I will be here, and I have a short clip that will play that will show some of the issues that we do. So our presence is filled in Kiambu, partly Nairobi, and recently in Nakuru County. We have 7 branches, 36 agents, and also adopted technology to run our activities with the farmer. We shall share more in the question and answer session, as we shall belabor more. Thank you so much. Kindly, you can have a look at my clip of the activities that we are doing with the farmers, the unbankable population.
This is Githunguri, a sub-county in Kiambu County, central Kenya, or call it Kenya's dairy capital. And at the heart of it is the Githunguri Dairy Cooperative Sacco, a financial institution that provides affordable short and long-term credit facilities to its members. Formed by just a handful of dairy farmers keen to improve their dairy farming and marketing possibilities, Githunguri Cooperative Sacco has now grown into a viable financing institution with more than 23,000 members.
We're still committed to ensuring that we remain number one. We are actually playing in a space where we are not playing with our equals, because within this space we are also competing with commercial banks. However, despite that, we have the touch with the ground and the youth, and we are able to deploy our solutions very fast.
Most of these farmers were adversely affected by an outbreak of foot and mouth disease in 2019. The FMD outbreak resulted in the loss of cattle for many farmers who were members of GDC.
Kim has actually avenues to help us in all facets. For example, the foot and mouth. We feel that with partnership from Kim, we shall now be able to get livestock veterinary expertise. We'll now be able to identify the specific variant that was so dominant and was resistant to the drug that had been supplied around this place. So that has made sure that we restitute our members to their previous position they were. That's currently how we are handling the issue, and we are still using the kitty under the Inuka loan product program.
The development of Inuka loan product is attributed to a partnership between GDC and USAID's Kenya investment mechanism. The USAID's initiative offers financial institutions success fees for lending to underserved sectors such as agriculture. GDC utilized their incentive fees to develop Inuka loan product for the benefit of their farmers.
Inuka came when we realized that these members were really affected, and it was impossible to use any other product that we had in place. And through Kim and the trainings that we went to, we found out that we were in a position to come up with another product that could pick these people from the zero they were, because a lot of them lost all the cows.
Inuka is specifically targeted at the members who have been affected by the foot and mouth disease. One beneficiary of this loan facility is Hannah Berry. The disease wiped out her entire herd.
Hiyo iwezekane. Kaniambia ni ukweli, twende, na wakanipatia pesa, nikakuja nikanunua ng'ombe hii inaelekea dry, nikanunua hii ya maziwa, nikanunua mori. Sijaamini ati saa hii niko na ng'ombe na ninauza maziwa.
Wakati ng'ombe zilikuwa zilikufa, bado nilikuwa na loan. Unajua sasa huwezi kaa hivyo. Nilikuwa na loan ya huko kitambo. Sasa wakaniambia iko loan nyingine hapa inaitwa Inuka. Sasa ndio hii sasa mnaona hapa.
Inuka loan product has been offered to 134 farmers whose livelihoods have been affected by FMD. GDC has loaned hundreds of their members through this product, developed using incentive fees earned from Kenya investment mechanism.
Thank you so much, Anne, and thank you participants for watching that short clip. I shall be available for the panel discussion where I shall share our experiences, challenges, and our wins. Thank you so much.
Thank you, Charles. That was a nice video, and you'll share more, especially what you're currently doing. I'll also now show us a short video from one of our panelists who unfortunately could not make it. This is Equatorial Debt Service Solutions. This is because they are currently facing a hard time, especially up in the north. And so he was left behind to help with the humanitarian crisis currently within the resilience zones. So please watch what Joseph has to present to us. Thank you very much.
Marsabit County boasts of a thriving livestock sector, which mainly comprise of indigenous cattle that can withstand the tough climatic conditions experienced in the region. But some farmers have opted to keep dairy cows. Matayo Wache is one of them and has beaten the odds to keep hybrid cattle in a zero grazing unit.
I tried and nikaona kwamba hapa sio mbaya kwa wanyama. Na mnyama ukileta ni vile utashughulikia. Itakupatia pesa na pia ijilishe. Yeah, kwa sababu hapa maziwa tunauza lita moja na 100 shillings.
Access to finance for farmers like Matayo is the biggest hurdle to doing business. Equatorial Debt Solutions, also well known as EDS, is a financial institution seeking to bridge and address access to finance for smallholders in the county. The financing institution has partnered with USAID's Kenya Investment Mechanism to deepen their lending to the agribusiness sector. Prior to partnering with Kenya Investment Mechanism, EDS did not lend to the agriculture sector. However, after partnering with KIM, EDS quickly expanded its loan portfolio to cover agriculture. Through new products they created, EDS started providing short-term working capital loans to agriculture.
So on the side of the livestock farming, that's an area that I think Kim motivated us to move into. And we met the kind of people we met, like Matai. When we met him, he had only 2 cows and he was struggling. So when he gave him the first loan, he bought some cans and some, I think some livestock medicines for deworming and all those things. I think when we met him, he was just a frustrated fellow.
It is through these new products for EDS that farmers like Matayo can get investments to expand their businesses. Through partnership with USAID's Kenya Investment Mechanism, EDS is now targeting underserved smallholders in Marsabit County.
We have tried to advise the banks. This SMEs doesn't have those collateral they're asking. For example, this farmer has about 4 dairy, 5 of them, but these are the collateral, according to me.
EDS is leveraging incentive fees from Kenya Investment Mechanism to better serve farmers like Matayo. The financial institution plays a key role towards enhancing access to finance in the northern Kenya region. Through the Pay for Results incentive fees partnership with Kenya Investment Mechanism, EDS has disbursed over 800 loans with a value of close to $300,000, all to underserved farmers in northern Kenya. The Pay for Results mechanism acts as a stimulus for KIM's partner institutions to provide financing to enterprises in value chains that are underserved, such as dairy, livestock, horticulture, and energy. The incentive creates viable opportunities for lenders to grow their client base and finance underserved sectors without creating dependency or market distortion. Financial institutions have the flexibility to use incentive fees for the purpose that best suits their business. Several have reinvested the funds to develop new products targeting the agriculture sector, while others have used their fees to open new branches like EDS in underserved regions.
Thank you and welcome back. You have now watched our second video from Equatorial Debt Solutions. And to help us with our conversations, I want to invite to the podium Mr. Anton Wambura, who is the director, Crescent Kaful Sacco. Anton is a financial services and organizational development expert. He's a career commercial and investment banker, a financial risk manager, an insurer, a specialist in credit risk management and microfinance, and has experience in Islamic finance. He helps establish the first Sharia-compliant bank in the country, and that is First Community Bank, as the pioneer head of credit, as well as he engaged with the Capital Markets Authority as the founding head of investment banking for licensing of FCB Capital. Again, he was also the founding CEO of Crescent Kaful Sacco, the first Sharia-compliant credit union, where he's active up to date now as a board member. Thank you and welcome, Anton.
Thank you, Anne, and it's a pleasure to have you.
Thank you. We are now going to invite our last panelist, and that's Naomi Ndele. She's the head of agriculture and SME banking in KCB Bank. Naomi has over 20 years experience in business banking, consumer and affluent banking, sales and relationship management. She's very results oriented, and Naomi is very passionate about financial inclusion, especially for the unbanked and underbanked, and champions the delivery of consistent, seamless, and trusted customer propositions. She holds very many education degrees, and welcome, Naomi.
Thank you, Anne. Good afternoon. Good morning, everyone. It is an honor to be part of this learning session.
Okay. Thank you. We are going to start off our discussions with, based on the video that we've watched from EDS. Anton, please share your wins, especially what you've been able to achieve as CTS. Thank you.
Yeah, thank you, Anne. And for us at Crescent Akaful Sacco, I can say that the biggest winner in the proposition between CTS and the Kenya Investment Mechanism has been the customer. And I'll just give a perspective to that. We operate in the northern region, in the ASAL, arid and semi-arid counties in Wajir. And as a SACCO, you find that our model is able to deliver financial services within that financial landscape. However, you find that the model that best works within that environment is actually a microfinance model. And a microfinance model is relatively expensive to deploy and to implement. And that's why you see that microfinance rates normally range are very high, maybe 18, currently ranging up to 30%. Yet, as a SACCO, we are not able to charge such kind of very high rates because the SACCO market is historically and traditionally in the 12% range. Therefore, the incentive program that we get from KIM enables us to deliver our microfinance services as a SACCO and without having to make our proposition unaffordable to the market. So I would say that is the biggest winner. The second one is basically in terms of support, in terms of product development, whereby we have been able to develop, we are developing specific products targeting youth and women. We are calling it the Ayuta Microfinance Suite. So that has been facilitated by partnership support. And finally, the other proposition and the other big win is your support in capital raising, which will now enhance our institutional capacity to be able to lend more. Thank you so much.
Thank you. Charles, I know you're very, you've talked about the Inuka product. Any other wins you want to share with us as a GDC SACCO?
Thank you so much, Anne. Githunguri Dairy Community SACCO, GDC, has quite a lot to share as wins. And it's actually one of the SACCOs that was formed by farmers who could not contain themselves within the main commercial banking scheme. And they started off a cooperative. So one of the greatest wins that I say GDC has been able to do is the resilience. They have a consistent resilience of growing from one point to another, from a small institution of 924 members to the current 28,000 members and 45,000 customers within the SACCO model. And that, to us, is a big win. The brand visibility is already in place. The expansion strategy that has been put in place, both digitally and the physical infrastructure, is a big win that we always need to celebrate about. But most of all, is assessing and providing financial or credit facilities to members who would otherwise not have been able to get that credit to a tune of 300 million shillings every day. We issue out credit an average of 300,000 Kenya shillings every day, which I see as a very big win for a cooperative. Thank you so much, Anne.
Thank you. In a rejoinder, Naomi, anything you want to share in terms of wins, especially in the agriculture or what you're currently working on?
Thank you, Anne. Maybe I could start by introducing who KCB is. So KCB Group consists of KCB Bank, Kenya, National Bank of Kenya. We are also represented in Uganda, Tanzania, Rwanda, Burundi, South Sudan, and we have a representative office in Ethiopia. We also have part of the group KCB Foundation, KCB Insurance Agency, and KCB Capital. And through this, we are able to serve over 26 million customers. We also have 350 branches across the region, over 1,000 ATMs, and most recently, over 26,000 agencies who support us in serving our customers. And through this broad network, we have been able to serve the underserved or financially excluded communities just by the broad network we have. We also, through the agency banking, has brought the bank closer to the people in local markets. That way we are able to serve communities who are very far away from the 47 county headquarters where we are represented. Over and above that, we have various solutions. I want to single out the Mifugo Nimali solution, which we offer to the Asol region. This is a livestock product, which we offer through the KCB Foundation. But over and above that, we have various agricultural solutions in very broad value chains, cutting across dairy to poultry, to just the normal working capital solutions, CapEx, trade solutions. So we have a very wide range of solutions. We also do have specific products for women because we realize that over the years, women have not been financially included. And also the youth through the Tujiajiri program that is offered by the KCB Foundation. All these are conventional and digital solutions. So I could go on and on, but in a nutshell, that is what we offer as a bank.
Thank you, Naomi. Yes, we've gotten the picture, and you've painted a very rosy picture. Is it always rosy, or are there challenges that you want to share with us?
Certainly, challenges come with every opportunity. Like my colleagues have not very broadly, they've spoken about it broadly. As banks, commercial banks, we are perceived in various ways by customers. And I must say we are feared. It's not a good thing because of that perception that banks will give you a loan, but they will come back for it and take everything that is yours and leave you in higher debt. And so that negative perception is something we want to really just try and dilute because we are not that bad. We want to work with our customers on the ground, both those who are in far-fetched places and also those who are in urban areas. We have also noted that banking is complex and it is actually a concern even for the illiterate groups. So with that, we are trying to come up with ways of capacity building to just demystify what banking is by offering this technical assistance, putting people in groups to just educate them about what banks can do for them over and above giving them loans. This is on the conventional side. On the digital space, we have noted challenges, especially access to phones. We in urban areas think phones are for everybody, but that's not the case. We have seen cases where phone handsets are shared amongst households and even neighbors. And so when we want to offer a digital solution, then it becomes a challenge in the sense that who is the authentic owner of that mobile number? And something very interesting that has come up even in this digital space, where phones are shared and maybe the head of the household is the one who keeps the phone, we have noted violence amongst families and towards women because the household head does not want the female, especially the wife, to be contacted by strangers. So it has all manner of implications. While we're trying to sort out a financial solution, then it has brought up other issues. So these are some of the broad things that we have seen coming up in this area of lending.
Thank you very much, Naomi. Anything you want to add, Anton, especially challenges?
Yeah, from Crescent Full Circle, we basically face a key challenge is really the cost of doing business in northern Kenya. And just to put it into perspective, Wajir county that we serve is 56,000 square kilometers. And Kiambu County is 2,500. Vihiga County is 530. In Nairobi, if I am to hire a vehicle for a marketing drive, it would cost me 3,000 shillings. In Wajir, I would have to hire a Land Cruiser at 20,000. There's no electricity, so we have to run on genset 247. There's no internet connectivity is almost given in Nairobi and other more developed areas of Kenya. In Wajir, it's very, very expensive and very, very unreliable. The second one is basically the level of, particularly of literacy levels. In Nairobi and Kiambu, we can talk of about above 85% literacy level. In Wajir, when we set up CTS, it was at 15%. Over the last 7 years, it has now grown to 23%. So even in terms of the digital literacy, that is a major, major challenge for us. So we find that, and actually that's where the incentive programs again comes in, because it helps us in covering some of those costs.
Okay, thank you very much. Charles, do you have any literacy problems?
Thank you so much, Anne, for that question. Well, comparatively with Wajir, I can say Kiambu is endowed. I don't have the statistical percentage, but I know that it may not be as much as it is in Wajir. So that has always been a challenge to us as well, but not very relatively. It has no significant impact on our business. What has really been the biggest challenge is the issue to do with securities and collaterals. That is what I can farm properly as the biggest challenge in the order of scale, because dairy farmers, the earlier started in my introductory remarks, is these people were earlier unbanked. So one of the reasons why they were unbanked is they could not be able to access credit facilities which required them to provide collaterals. And the cooperative model came up with a co-guaranteeing model, which over time has also saturated, meaning most of the members have guaranteed among themselves until there is nothing to guarantee one another. That moves us to the second level of a challenge, where we are now talking of collaterals. Are they able to bring other securities other than co-guaranteeing title deeds, charge them? And that's why, through this initiative, when we got the pay for performance, we actually sat down as a team of product development agents and said, we can use the same cow as security for loans that members are taking. So I will say that collateral has been the biggest challenge. And I'm sure when we start talking about how we have handled that, it will come out. There's also the second issue of cost of animal feeds. From an economic point of view, when you do the cost of production of animal feeds vis-a-vis what comes from the milk sale, it sometimes doesn't make a good business case. Because the cost of the feeds will be extremely too high. If you feed into the equation that gives you a profit, you'll find, of course, it will give a negative. So this is an area that I see as a gap, even up to now, and it's a big challenge not only to us, and I'm sure in most of the business value chains that are adopting that. The cost of feeds is too high, the cost of doing business, as you have said, but to us specifically, the cost of feeds that we give to these dairy cows seems to be eating across even to the income that would have been left to the farmer. In the order of priorities, those are the two major challenges that I've actually faced as a CEO of Githunguri Dairy Sacco.
Okay, thank you, Charles. Just to understand more, that security or collateral is one of your major challenges. How have you gone to mitigate that risk? What have you done as an institution?
Thank you so much, Han, for that question. We are dealing with it from a low-level perspective because my members borrow Kenya shillings 50 million and below. 50 million and below, we have not lended any single member more than 60 million. So the highest of them are 60 million Kenya shillings. Well, that's quite an amount. But let me talk about the masses. The masses of farmers who do not have collaterals, we have made it very simple for them. We have been able to work with the insurance companies to actually take livestock as an asset, of which it is, and get an expert's opinion, who is usually a vet, to determine the value of a cow. Most of the cows range in the range of 200,000 to 250,000. Very few of them get to 300,000. So that innovative drive of a vet being able to determine the value of a cow, it itself becomes security, because we compel the farmers to get insurance for their livestock, which is usually a percentage of the valuated amount by the vet. In most cases, the premium is too small. It's actually an average of 4,000. And you see a farmer borrowing to buy 10 cows will be able to get insurance for the 10 cows, isn't it? And actually avert a risk to a tune of 20 million. That is how we have been able to handle security for these dairy farmers.
Thank you. Anton, how have you managed to risk mitigate some of the things that you shared with us?
Yeah, again, from a landscape perspective, Northern Kenya is classified as trust land, and this applies to 99.9%. So only 0.1% of the land is available as collateral. So we are basically talking about the CBD of Wajir town. So beyond that, there's nothing as collateral. So basically, for us, we have had to innovate and create. We have actually created a hybrid model, a hybrid between cooperative and microfinance, to be able to create alternative collateral alternatives. And particularly, we have also been able to leverage the high trust levels within the community. So a lot of our financing is community-based. We find that we can get key man guarantees from business leaders, the sheikhs and the imams, and that the community trust level is very, very high. So that's how we are dealing with it.
Okay, thank you. Naomi, would you want to add anything for risk mitigation?
So lending to MSMEs, and especially those in the agri-sector, is deemed high risk, and this is because they are most vulnerable to the environmental shocks around, especially around weather and climate issues, political risk, and also the ongoing pandemic has really hit this kind of sector, the MSME segment. So in regards to this, we partner with various institutions to offer us support through risk-shared guarantees, like the government of Kenya. We have partnered with the National Treasury on that. We have also previously worked with USAID on a credit guarantee risk share agreement. We are also working with Kenya Institute of the Investment Mechanism team, who are offering the pay for performance. And all these interventions are to enable us just weather through the risks. Most importantly, and recently, is we take some of the funds that the investment mechanism through the pay for performance to come up with products that will enable us reduce the risk by concentration risk in some of the products that have been taken up previously and have not performed well. So that opening up for more products enables us to even lend to more customers. The risk share guarantees, we are able then to cover on our losses. We also have insurance solutions through the KCB insurance agencies. Some are tagged to the loan solutions, but others are standalone, where we can, like he said, insure the animals. We can also insure the life of the borrower, so that in event of anything, then the loan is, the family will not be affected. And then the fear of working with banks is also reduced. We also are keen on doing capacity building, and certainly we will spend some of the money through the pay for performance to build capacity and give technical assistance to our customers, mainly even the women. We have noted women need specific interventions to just give them that confidence that they can do business or they can engage in agricultural initiatives without fear. So all these interventions are really some of the ways that we are mitigating the risks.
Okay, thank you. Anton, you raised something at the beginning of our discussion where you talked about the digital financial services and the way it fosters financial inclusion. Would you share more, especially what you're currently working on?
Yeah, definitely. Given the background that I've shared already, it is not really feasible for us to be able to do many branches and marketing office and agencies. So what we have done is to create a digital circle, a CTS digital circle, as an online platform. And we feel that this will enable us now to have universal reach. Secondly, it will also be able to help reduce our transcommunication costs, both for the institution as well as for our clients. We find that our clients would travel 100 kilometers to access our services, and that was very, very costly. So it will be much more convenient and less costly by using the digital circle.
Okay, thank you very much. And Charles, anything you're doing on the digital front?
Thank you so much, Anne. And on the digital front, we actually started this journey 2-3 years ago by, first of all, applying simple solutions, whereby we actually sent notification messages to farmers. That is some level of digital uptake, because every time that members take milk to milk centers, in most cases, the milk is not taken by the owners of the cows. It's usually taken by employees. So we have automated the process. So members are able to get a notification message that this number of liters have been delivered at this time. That's the level of digital uptake. The other one is about the circle itself, now the financial component. Every time a transaction appears on a member's account, after they have deducted their fees and each other activity, still a free notification comes through. Currently, we currently also have a USSD code, which we use. Our members are able to use *645, then select GDC Circle. From that platform, they are able to apply for loans, because sometimes farmers might want to get 10,000 to buy a very urgent drug for their cows. That does not mean they need to travel physically to the office. They should be able to apply for that small facility using our USSD code. Sometimes they also want to settle their debts to other banks. They should be also able to use the same platform and transfer their funds to any of the banks that operate in Kenya. So I'm sure the digital platform, far from it, we have not really achieved as much as we would want to. We are in the process of actually taking a self-onboarding method, whereby our diaspora members, we have so many members from within Githunguri who stay out of the country and who are members. We are currently working out, because we also work with the banks. We are not competing with banks, and in this case, it's actually KCB, who is actually seated next to me. We are actually competing. We are not in any competition, we are competing. And we currently have accounts with them, and another one with ABSA, where we are able now to have dollar accounts so that our members are able to work. So I'm sure the synergy level of working together with institutions and not competing is actually, this is the era of shared services. I must emphasize that point. And true enough, there is no institution that will be able to survive on its own. I need KCB, I need Cooperative Bank, I need ABSA for these platforms. So our USSD is able to cross-cut all those banks. And right now, we are working on an app. And this app, I'm sure it will have challenges for the aged. But we are going to slowly introduce it to the young populace. They shall be able to play short video clips along that. They can be able to apply for loans, sign digitally, and then get their loans. So I still feel the future is in digital. As we have already used portion, the pay for performance kitty, we used some of it to expand our branch network, not physical, through agents. So there was a lot of technology deployment. Of course, we required telecom, Liquid Telecom, Safaricom. So in all this journey of finance, we must have so many players we need. So our digital platform, we shall leverage on fintech companies and other already established financial solution institutions to guide us through. So that is where we are, but I know the future has a lot for us.
Okay, thank you. Naomi, do you want to share anything, especially on the digital financial services?
Yes, and we do have a number of digital solutions. I would start with the mobile banking, which is available on USSD and also as an app. We also have the Vuma payment solution, where customers can make payments via that Vuma channel. We also do have, for the agri-space, the Mobi Group platform, and this is a solution that enables smallholder farmers who are not able to access the bank to open a digital account, which is transactional. They're able to save, and they're also able to borrow through a credit line on that particular platform. We also do have KCB M-Pesa, which is broadly used across the country. And all these have impacted various customers in many ways. So I'm sure you've all heard of the story of the lady, the Mama Mboga, who buys vegetables from Marikiti Market every morning. And KCB M-Pesa has enabled her to not only transact virtually, in the sense that she doesn't leave her home as early as she used to. She would get up at 4 a.m., go to the market, buy her goods, take them to her stall, get her children ready. All this was really getting into her time, but the KCB M-Pesa has enabled her to transact away from the market, so she's able to pay somebody to buy the goods for her at the market, send them to her stall. Meanwhile, she's preparing her family at home to go to school, for the children to go to school. The goods are delivered to her kibanda, and she's able to sell them throughout the day and close early. Now, at 5 o'clock, she borrows to pay for the goods at Marikiti Market. She's able to trade with that money throughout the whole day, and at 5 o'clock, as she closes her shop, she's able to pay the loan. So we have enabled daily access of loans, enabled the progress of this woman who initially would not even sometimes have capital to buy her goods and services, to be able to service her clients. And so we, through these digital solutions, have been able to bring convenience to customers, and also enable those who had never borrowed because they didn't have collateral. They're able to access these small loans to enable them grow their businesses.
Thank you very much, Naomi, especially the story on the Mama Mboga. That is why we are here, to transform the way our Kenyan people live, and especially how they do business, and especially in the agricultural space. So I thank you very much, Charles Kioko, for being with us today and the work that you're doing. I thank you, Naomi, for being with us, and also Anton. But right now, we need to go to the questions and answers. I hear there are very many, and we need to have some time to answer the questions. So over to you, Yusuf. Any questions?
Thank you, Anne. We have a number of questions here. They're coming in really fast. But before that, there's somebody here on Twitter who's still struggling to believe how one dairy cow will cost about 250,000. He's saying it's almost the equivalent of a Vitz car. That says a lot about, the need for people to understand that actually livestock is valuable. So there's one question here from Robert Ndiema. He's saying, hi all, I am Robert Ndiema from OCA. Question to the panelists, are the business models replicable in other counties, regions? I believe that is a question for GDC and Takaful. But of course, Anne is the boss there. She's the one who's going to distribute the questions. Let me share two more here, Anne. Quick one. Yes, this question is to Naomi, KCB. As a commercial bank, how are you dealing with issues of lack of collateral to help agri-businesses like ours access credit? And can I take two more?
Let
You
them.
have room for one?
Okay,
Maybe I
one
can just
more.
add one. Okay. From your experience, it doesn't mention, they don't mention the name or where they work. It's just a question, dry question. They're saying, from your experience in the financial sector, do you see lending to agriculture as a risky venture?
Okay, thank you. Charles and Anton, you can respond to the first question as Naomi gets ready for the second question.
Definitely, our model is replicable. However, for us, our model, first and foremost, beyond the product model, the institutional model is Sharia compliant. This would mostly be applicable, particularly whereby there is a large number of members who profess the Islamic faith. However, the model is not exclusive. It's only that the contract that will be signed will have to be Sharia compliant. So we actually have almost 40% of our membership being non-Muslims, but the model is mostly meant to bring into the financial fold people who profess Islamic faith, and it is actually replicable, not just in the Asal counties, but actually in the Horn of Africa.
Okay, thank you. Charles?
Thank you so much, Han. And for the viewer who has raised that issue, whether our model can be replicated, the answer is no. The answer is no, because you can never replicate a model exactly as it is. What I can say is that you can borrow much from what we are doing and then tailor it to a specific issue component of where you are doing. Because if you borrow the Githunguri dairy model, and Githunguri dairy is actually supported by the fresher plant, of which is a whole value chain. If you borrow it and replicate it in your place, it won't work 100%, isn't it? But there are certain components that you can borrow from Githunguri dairy value chain model and replicate it into an institution. But 100% cut-paste won't work.
Okay, that makes sense. Thank you. Naomi, over to you, the second question.
So to the viewer, yes, we do have lending that is not based or attached to collateral. So we have unsecured borrowings. Depending on the amount that you're looking for, we are able to use your cash flows to enable you access credit without collateral.
Okay, thank you. And the third question, we can have Charles and Naomi respond to it. Is agriculture risky? I think that was the question, Yusuf? Yes.
Yes, I could go. Yes, agriculture is very risky, mainly because some of the underlying issues are, you don't anticipate them, like climate issues. Last year we had the worms that affected the crop production. This year, there's some places with drought. So those are beyond the control of anyone. That's what brings the risk. But that said, we have mitigants, things that assist us go around the risk and support even those in those sectors that are greatly affected by these unforeseeable conditions. So we do acknowledge it's a risky business, but we do have areas and ways of mitigating it so that we are supporting, especially agriculture, which is a key GDP earner for this country.
Yes, absolutely. Charles?
Yeah, thank you so much. I actually agree that lending to agriculture to the agri sector is a high risk. Actually, it's a high risk because we have the BDI risks and the low BDI risk is actually a very high risk venture. To agri, and that's why the concern to agriculture is very key. It is from there that we get our food. And financial institutions don't want to lend to agri. Some years back, they were averse to lending to agri sector. But with the innovations and the solutions that are coming to mitigate the risk, crop insurance is already there in case of rain or natural vagaries that can come. Livestock, we have livestock insurance. However, with the exception of the mitigants, most of the financial institutions would not want to lend to a Greek. And that's why these learning events are very important, so that once we meet, we are able to discuss how can we go around such a risk? How can we motivate this sector to have a high appetite for loaning? So the bottom line is, it is a risk, but we are coming up with solutions to go around that risk.
Okay, thank you very much. Anton, what does the future look like, especially for Crescent Taka Full Circle?
Currently, and going forward, we are focusing so much on further digitizing our product propositions and also our product development. Specifically, we have just developed a youth-specific product. We're calling it Ayuta Vijana, which is again a community financing product. We are following up that with the Ayuta Women, which is now going to be more focused on the women segment. And lastly, particularly now as we look forward to the economic recovery, we are in the process of fundraising. Again, a benefit that we are receiving from Kim. We are hoping that we'll be able to come through so that we have the institutional capital to be able to deploy more funds in the coming year.
Okay, thank you. And Naomi?
So we do acknowledge that the MSME sector in this country has been recognized for the role it plays in providing goods and services, in fostering innovation, in enhancing competition, and all this is towards alleviating poverty. And agriculture is one of the sectors that plays in a big way in this MSME segment. We acknowledge that it is the missing middle in the sense that because of various reasons, they're unable to access finance. So as a bank, we are very keen to support the MSMEs across all sectors, including agriculture, because we are very aware that 50% of the employment in this country is created from MSMEs, and also 33% of the GDP is generated by these businesses. And so we are keen to support everybody out there who is a business person in agriculture specifically, and in line with the Big Four agenda of food security. And so we are asking that you speak to us as a bank. We have solutions, both secured, unsecured, digital. We have trade finance, which we are enabling people to trade across the East African region. We have various value chains that we are supporting. So I would encourage that we have this kind of engagement. Wherever you are, we are represented, like I said, across the counties. Feel free to speak to us, and we will be able to support you, to prosper you and to grow your businesses.
Thank you, Naomi. Anything you want to add, Charles?
Thank you so much, Han. The future outlook can be summarized as the potential being unlimited. There's a lot of potential there in the agriculture sector. With the urbanization that is going through, you'll find agriculture will be very resilient. So our future outlook is to encourage the young people to join agriculture. Not to take, because from the statistics that we are finding is that the average age of a farmer is somewhere there around 60, 61, thereabout. That means the sustainability and the business continuity of dairy and other agriculture-related activities is not promising. That not promising for us is a potential that we want to tap into by encouraging the youth to join into agriculture, then adopting digital transformations to make it easier for them. At Githunguri, we also want to apply a lot of mechanization so that we are able to reduce the cost of manual activities like milking, where somebody who is milking 20 cows might have to take 3 hours. If we mechanize the whole system, to be able to do a milking for 20 cows within a very short period of time. So in summary, therefore, I say that the future has very unlimited potential. There is so much in the agriculture sector that is available for each one of us to take through. And GDC has already taken the leap into that space. Thank you so much.
Thank you very much. I'm sure we've all learned a lot from our panelists, and I want to thank all our panelists for sharing their lessons, their successes, their challenges, and even ways that they have mitigated risks in whatever they do. Some of my key highlights that I have been taking notes are that in agriculture, it might be risky, but we all have success stories to share, as we have heard from our partner financial institutions. And number two is everybody is now focusing on digital, and we are enhancing how our women and youth and people living with disabilities access credit and access finance, and also enjoying the fact that everybody is keen on doing financial literacy for their customers. And lastly, that listening to the three panelists, there is so much in terms of future growth. There is so much that we can expect from them. So I hope that you've all learned a lot, and you will join us in this journey as we continue working together with our partner financial institutions. Thank you very much for your time, and I will now hand over to Yusuf. Thank you.
Thank you very much, Anne. Thank you very much, Anton Wambura is the director. Crescent Takaful Sako, thank you very much for your time. Not forgetting Naomi Ndele, head of SME Banking, Kenya Commercial Bank, and I've intentionally left Charles behind because I need a dairy cow at least, Charles. The 250,000 one. But I doubt if it will survive in Northern Kenya. Or we'll do some crossbreeding. Thank you very much, Charles Kioko, CEO, GDC Sako. Now, ladies and gentlemen, I know it might be bad. The next session is going to give us all the mobilization, not just capital, long-term capital mobilization. We're going to look at the alternative models, and I'm sure Paris and her team are ready. And let me take this opportunity to go through Dr. Paris Mburu. He is the next moderator of this very important session. Dr. Paris, business States Kenya investment mechanism. Paris has a great wealth of experience working in international development and banking. Her experience includes working and managing relationships with financial institutions, SMEs, consultants, implementing partners, and business advisory service providers. Her bio is there for all of you to see clearly. We are in safe hands as far as the next moderation is concerned. And as the panelists prepare there, I'd like just to remind you our poll question once again. We did ask you earlier, are financial institutions innovating to serve market systems? Are you seeing different kinds of, products perhaps from these financial institutions so that they get that we'll have some evaluation questions for you so that we know this session has been good, but we want even in future to make our next engagement even better. And that all is pegged on how you're going to answer some of the evaluation questions there that we've posted in the chat box. Dr. Perez, karibu sana, and Tom.
Thank you very much, Yusuf, for that flowery introduction. Much appreciated. In this session, we are going to be looking at alternative models for raising long-term capital in the market. We all know what long-term capital does to an economy, to an organization. And we will be joined by very experienced transaction advisors, business advisory, service advisors, as well as an organization known as KEPFIC, who have benefited from such services in raising or being able to model long-term finance to support infrastructure. To kick us off in this session is Mr. Ruben Mabishi. Ruben Mabishi is a research analyst at Dry Associates and is responsible for supporting the investment banking, debt issuance, private equity, and corporate finance activities. He previously was an investment analyst at Seaton Investments, a local alternative investment management firm. And previously, before that, he worked for Columba's OH office of JP Morgan, Chase and Company as a complier. He earned a BA in biochemistry from West Virginia University, cum laude university honor, and an MS Finance from the Weatherhead School of Management at Case Western Reserve University, where he was a recipient of a merit scholarship. Over to you, Ruben, for your presentation, and thank you for coming.
Okay. Good afternoon, everyone. Thank you, Paris, for the introduction. I'm not as great as it seems. I'm just doing my best over here. So as Paris introduced, I come to you from Dry Associates Investment Bank. We're a bank, but not unlike KCB. We're licensed by the Capital Markets Authority as an investment bank. So what that means is we go direct to investor to put together either long-term, typically debt, mostly debt funding solutions in order to get money directly from investors to the companies that need it most. Next slide, please. So for today's presentation, I guess we're going to begin with, I'll just begin with a brief introduction to who we are and what we do as Dry Associates. Then we'll just go through a short case study of Watu Credit, which is one of our premier issues that we started with this year. And we'll just go through some lessons and takeaways from our partnership with the Kenya Investment Mechanism. And then after that, I'll go through, give my thanks, at least pass our thanks as Dry Associates to Kim for the work that they've been helping us do, at least for the past year we've been in partnership with them. Okay, good. Okay, so Dry Associates, our mission is we believe in professionalism. We want to be the premier investment firm in Kenya, and we bring you both local and international investment solutions. And our focus is pretty much integrity. We want to be the best that we can be and do the best that we can do for you. And we take our fiduciary responsibilities extremely seriously. Essentially, we really want to earn our clients' trust. So if we look at a product-by-product overview of what we do as Dry Associates, we do participate in both short-term and medium-term. That's short-term is anywhere from 3 months to a year. Medium-term is anywhere from 2 years and beyond. And then we also participate, we also have a thriving unit trust funds unit, and we also do offshore funds through Franklin Templeton. Part of our issue was from names you're actually familiar with, Watu Credit, who we'll be going through today. We also do a commercial paper and a bonds program for KK Security. And we also work with Car in General, through whom we have both a short-term notes and longer-term, medium-term notes program. And we also work with ASL Credit, who is part of the Ramco group. So for the short-term notes, we have about 5 billion outstanding. For corporate debt, we have about 2.5 billion outstanding in medium-term notes. And then for unit trust, we have 3 billion under management. And we're also the local Franklin Templeton Funds affiliate. Good. So if we'll go back 2 or 3 slides. Please. Number 7. So we'll just go through an overview of Watu Credit. If you've been driving or riding anywhere around Nairobi, you'll be fortunate enough to actually run into a boda who has a yellow jacket, much like Iris Media, that says Watu Credit on it with the logo Move and Improve, right? I think almost everyone's seen. So they are part of our handiwork, one of our prouder programs. What they do is they provide asset finance for two-wheeled and 3-wheel vehicles. So essentially what the company does is they work with motorcycle dealerships to provide a loan so that boda operators and others can access funding to actually now buy their own motorcycles by paying over time. So they're the leading provider of asset finance. Not only are they in Kenya, but they also have an operation in Uganda that's been working for 2 years, and they also are working to set up in Tanzania. They also have units that are starting out in Nigeria and Sierra Leone. Watu's mission is to actually serve the underbanked with financing. So there's a huge demand for credit especially at the bottom of the pyramid. So these are people who we say wouldn't traditionally have access to conventional banking facilities because they don't have property or they don't have any form of collateral or asset with which they can use to secure a loan. So what Watu does is provides the asset first and uses that collateral and then advances it to the rider who then uses it to earn a living. And then if we look at some of the company's successes, Watu's actually been very, very successful at empowering women. 12% of Watu's borrowers, we currently are securing a pool of about 20,000 loans. About 12% of those are women. We actually have 39% of borrowers, at least according to the company, who live in poverty. So about 18,000 borrowers are female, and about 70% of borrowers are younger than 35 years old. So Watu's mission is to provide us affordable access to finance. And so let's now go ahead. After the introduction, let's segue to at least the lessons that we've learned by working with Kim. At least, first of all, when it comes to successful companies that work with us to actually raise funding, they understand that every single firm that they're actually going to raise money from has a core competence. So for us, our specialty is corporate debt. So we're looking for companies that actually are able to not only take on debt, but then steward it wisely, knowing that, for example, as a practicality, you have money that's coming due that's to investors in a year. You have to be able to cycle that money through your business and make a return on that same money by the time that year is over, or else we'll have a problem, with your investors. So the other one is we typically like entrepreneurs who are investor ready, who know what investors want out of the process and have actually structured their businesses to actually give investors what they want, or a pathway to showing investors that they can give them what they want. And then the other thing is timing, because the process of raising money does take time. Then it's very necessary for investors to understand that it might take 6 months for you to get the money that you want. So you have to be cognizant of that and work it into your operational processes and your fundraising timelines to make sure that there's no overhang. Yes. Lastly, we'd like to thank the Kim team for your support in actually giving us the deals to review and your availability, especially with calls to founders and outreach, and just for creating the ecosystem through which we are actually able to link up with deserving firms, and your timely support, and actually also for your assistance with other USAID review and pay for performance programs. So back to you, Paris.
Thank you very much. Thank you very much, Ruben. Our next presentation is coming from Mr. Ngatia Kirungi. Ngatia was not able to be here physically with us, but we have his video recording. Ngatia is the head of Kenya Pension Fund Investment Consortium, KEPFIC, which is a consortium of local pension funds with approximately 5.25 billion in US in assets, which come together to jointly assess and invest in infrastructure opportunities in the East African region. Ngatia has extensive experience from large financial institutions in New York, London, and Nairobi. He's the founder of Spearhead Africa, a Nairobi-based alternative investment and advisory business, innovative financial structuring, and alternative sources of capital to businesses in East Africa. Welcome to Mr. Ngatia's presentation.
Good afternoon, ladies and gentlemen. My name is Ngatia Kirungi, and I'm the head of the Secretariat of the Kenya Pension Fund Investment Consortium. I'm here to talk about KEPFIC, for short, and some of the lessons learned as a Kenya Investment Mechanism business partner. But before I start, maybe I should start off first by thanking our hosts for having us today, the Kenya Investment Mechanism, and all the support they have provided KEPFIC since our inception up to date. I'll start with a little bit about KEPFIC. So KEPFIC is a consortium of local pension schemes, both public and private sector, large and small, that have come together to jointly assess and invest in infrastructure opportunities in our region. So in Kenya first, but eventually going into the wider East African region. We have a 5-year target of investing at least $250 million into infrastructure, and which has previously really been the domain of governments and the donor community. And we strongly believe that there is a big role for Kenyan pension schemes and the private sector in general to play in the infrastructure development of our country. Our aim is to provide competitive returns and diversification opportunities to our members while building on their technical and investment capacity. And finally, to be the collective voice of our members on policy and regulatory matters. We have a number of partners, first of which is the USAID's Kenya Investment Mechanism, who have generously supported the KEPFIC Secretariat. We're also supported by the World Bank Group and MIDA advisors. And KEPFIC has actually been recognized as the Pension Fund Infrastructure Initiative of the Year. This was back in 2019 at the Africa Investor Awards in Cape Town in South Africa. But if we take a step back and ask ourselves, why is infrastructure a compelling asset class for pension schemes to invest into? A number of reasons are very apparent. First, infrastructure provides competitive returns. Now, we would not even be having this discussion if that wasn't the case. So infrastructure, the returns are quite attractive, and they provide reliable cash flows. Secondly, as I have mentioned, infrastructure provides a good opportunity for diversification for our members' portfolios. And this is especially important in a market like ours, where you find that majority of pension scheme portfolios are invested into government securities and probably just a handful of stocks. There is definitely a need to increase the pool of investable opportunities for these pension schemes, and infrastructure is a great alternative asset to do so. Finally, infrastructure investments are long-term in their nature, and so they allow pension schemes with long-term liabilities to match those liabilities to a long-term asset. At the same time, when you're thinking about a long-term investment, it's important to consider inflation. Infrastructure, through its very nature, and because it's typically tied to inflation, at least the revenues are tied to inflation, what that means is that in 10 years' time, if inflation goes up, rather than it eating into your returns will go up with inflation, and so you are always protected. And that's very important for long-term investors like pension schemes. We have quite a few lessons learned through this process. The first is the importance of having credible transaction advisors to gain the confidence of investors, in our case, trustees and the fund managers. This transaction would have been a lot more difficult if the sponsors approached us directly and didn't have a strong name behind them that we had confidence in and that had structured the transaction in a manner that would be appropriate for our membership. So I think that's a good point to raise in terms of the importance of the BAS providers and how they can really do a lot to unlock private sector capital that is just waiting for well-structured projects. Second lesson learned was the importance of giving yourself sufficient time. Very rarely do these transactions happen as fast as we would like them to. And what we learned is that it's important to give yourself enough time to allow the completion of the required documentation and sufficient time for internal deliberations. You'd be surprised at how many rounds of discussions you'd have to have with each pension scheme's investment committee, the board of trustees, their fund managers, and back again. So the third lesson learned is really about the guarantees. And the guarantees, while very welcome, we consider them as training wheels. And they're the training wheels that will allow pension schemes to begin investing into infrastructure, but after some time, these training wheels will fall off. And then we will have to invest on our own, basically on the merits of the project, and which is fine. However, any kind of guarantees in place, while welcome, should not come at the expense of returns. As I mentioned, the transaction that we are looking at had guarantees but still had to have a sufficient return for our members to participate. I've talked about the fund managers quite a bit, but let me just reiterate that the fund managers are really important in unlocking money from pension schemes, and it was really important to have the buy-in from them on these investment opportunities even before approaching the pension schemes, because the fund managers are the pension schemes' trusted advisors. And we recognize that, we respect that, and we are working very closely with them on all opportunities. I mentioned the number of engagements. So one-on-one presentations are extremely critical. And we find that investor awareness doesn't happen with just one engagement. Investor awareness or investor comfort really requires multiple engagements from multiple touch points, and a lot of patience is required to do that. And so having support of the Kenya Investment Mechanism to really facilitate those kinds of engagements has been critical. And finally, it's important to note that there are also non-investment risks that should be addressed. These are such as reputational risks or concerns about the role of government, corruption, political exposure, and the likes. So these are the risks that are not seen in the financial models or typically in the documentation for the transaction or the teasers. So what we learned is that it's very important that even if they do not show themselves in the numbers, that they are adequately addressed. So with that, I will stop the presentation here. And I just want to thank you very much for having us. Again, Kim has been a very important partner to KEPFIC, and we look forward to continuing working together and to growing the relationship in the future. Thank you.
We want to thank Mr. Ngatia once again in absentia for that very insightful presentation. Now, our next session is going to be a panel session. And in this session, I'm joined by two additional panelists, including Ruben, who's just given us his presentation. So on my right, I have Mr. Geoffrey Gangla, who's the Chief Executive Officer, Genghis Capital. Geoffrey is the CEO of Genghis Capital and a seasoned African investment banker, specializing in advisory and capital raising. His 20-year-plus career journey has seen him practice in Nairobi, Joburg, and Lagos, giving him a unique Pan-African financial services experience across 3 major business hubs. A generalist corporate financier, his work experience covers M&A, corporate finance, acquisition finance on both public and private capital markets. Geoffrey has successfully carried out transactions valued at more than 10 billion, and is a member of ICIFA and CFA Institute. Geoffrey also serves as the chairman of the Kenya Rugby Union. The other panelist is Neha Shah, and Neha is the managing director of Maitri Capital and Rafiki Ventures. Neha is the managing director and co-founder of 2 financial institutions, Maitri Capital and Rafiki Ventures, as I've mentioned, a firm that is focused on Africa and early stage investor in technology-enabled enterprises. Neha has 18+ years of experience in private equity and investment backing. She has spent a considerable amount on the ground in Africa, leading the transformation of SMEs. Neha worked at Actis, one of the emerging market funds, focusing on energy and infrastructure investments. She's a chartered ACAEW of the UK and holds a master's degree in economics from the University of Cambridge and from INSEAD, INSEAD. She was awarded top 40 under 40 women by the Business Daily in 2019. She's a board of several private-owned businesses and charitable organizations. To kick off this session again, I will give both Geoffrey and Niha time to tell us about their organizations, what they do, and how they have helped organizations innovate in raising long-term capital. I will start with you, Geoffrey, and then we go to Niha.
Good afternoon, ladies and gentlemen. Firstly, my great appreciation to Kenya Investment Mechanism for inviting us to share our insights and thoughts, having worked with the program for the last few years. By way of introduction, Jenkins is pretty similar to Dre Associates. We are a licensed investment bank regulated by the Capital Markets Authority. We have three main product verticals. One is securities trading on the Nairobi Stock Exchange, both the listed shares and the listed debt, government bonds. The second part, and we also do quite a bit of research, which is available to the general public and to investors. The second part is the advisory business, which basically I spend most of my time on, helping clients raise capital and helping clients in the execution of mergers and acquisition transactions. And then the third part of our business is the asset management business, which basically acts as a mobilizer of capital. So we create products which are regulated by the Capital Markets Authority, and then basically go out there to mobilize savings. We have taken a very keen interest as a firm on the digitizing investment solutions. When we look around, banking has become very digital heavy. So if you look, you can do everything on your bank account from the comfort of your phone or on the internet, and pretty much gone through several revolutions with M-Pesa. Now we've seen a lot of new service providers, digital lenders, different kinds of payment solutions. But investment banking hasn't evolved in the same way over time, and I think we've already making quite a significant contribution in terms of just changing the whole route to market. And we are quite passionate also about building pools of local investment capital and putting them into organized investment vehicles. You find Kenyans are investing a lot, but not through as many investment vehicles as would have liked to see. So if you take out the insurance sector and you take out the pension, the rest of the other sub-segments are quite small, and I think that of itself creates a big opportunity. People are saving, but not necessarily through the formalized market. So that's an area which we are quite keen on seeing, and which will then help us address the long-term capital needs of organizations and of investments. Thank you very much.
Thank you, Geoffrey. Over to you, Niha.
Good afternoon, everyone. I am Neha Shah, the co-founder of Maitri Capital. Maitri Capital is an investment and a corporate advisory firm with a focus on Africa. We provide three main core services. One is mergers and acquisitions. The second is capital raising, which involves equity, debt, grant funding. And the last one on the corporate advisory side is financial management, interim CFO services. And that's really to support SME companies to scale up and take them to the next level. So I set up Maitri Capital with the vision to take our homegrown African companies and get them to compete on a level playing field with our global peers. And our vision and mission at Maitri is to do that in three ways. One is to bring financial capital. Secondly, it's to bring human capital. And thirdly, it's to bring technological capital into our homegrown African companies. With that, I will segue into one of Paris's questions into how we've managed to bring on board patient capital with the SMEs that we've advised on. So last year, which completed this year, we advised an agriculture business on a merger and acquisition. It's a company that provides inputs, seed inputs, mainly vegetables, into probably around 8 African markets. And we combine them with a South African company doing exactly the same thing. The owners of both the companies are looking at a very long-term, they've been existing for more than 40 years and envision themselves even lasting beyond another 40 years. So the right way for them to grow was to combine forces and become one of the largest Pan-African distributors and producers of seeds in the continent, again competing with the global peers like Syngenta and Monsanto. So yeah, that's an example of how we've enabled patient capital into the ecosystem.
Thank you. Thank you very much, Neha. So, and just to continue with our panel discussions, I'd like us to take a step back and just put everything into context. Why is long-term capital important for an organization, a government, and why are financial institutions limited in raising long-term capital? We'll start with you, Ruben, then Neha, and then Geoffrey.
So to start with the first question, long-term capital is important because if you look at the day-to-day cycle of a business, there's working capital, which is what they use to pay salaries, pay the bills, meet supplier payments, and so on and so forth. But then you need long-term capital because it's now a survival issue. We usually say at Dry Associates, you either grow. If you don't grow, then you stay stagnant. And staying stagnant is as good as dying. So companies need to, there's an urgent need, it's an existential need for companies to actually raise long-term capital, because then that allows you to actually not just create product to grow, but also allows you to move on to take advantage of those opportunities that may be apparent, but may not be accessible at least until a significant time horizon has passed. So companies definitely need to raise longer-term capital, because it's not just for day-to-day, but it's a survival and an existential issue for companies. You have no choice but to grow in whatever type of industry you're in.
Thank you, Ruben. Neha?
Just to add to what Ruben has said, long-term capital is also patient capital. It's where the providers of capital are not wanting their returns immediately, but in the foreseeable future. They also have a high tolerance for risk. And what these two factors allow them to do, allow companies that are utilizing this capital, is to innovate in a very safe environment and produce goods and services that can last generations. So it allows them to build very value-based businesses that can go into the long term. And that's really what patient capital unlocks.
Thank you, Neha. And Geoffrey?
Thank you. I think my colleagues have made good observations. The only thing I'd add to that is Ngatia earlier spoke about the need to match, the matching of assets and the matching of liabilities. So from a company's point of view, there's also a need to be able to match. If you're building an asset for the long term, then you also need long-term capital so that you're not under pressure. At times you need an asset which will take a long time to be able to generate a return. So it's important to be able to have matching capital that fits that risk profile as Neha has described.
Thank you, Geoffrey. And I think in that, then we see the limitation of financial institutions in their ability to lend long term. Would you like to just highlight some of those limitations, say, Neha?
So we'll just speak broadly about financial institutions. So financial institutions, the broad spectrum is not just banks.
Yes.
Most people think financial institution, banks, but across the spectrum of capital, you have private equity funds, you have venture capitalists, you have endowments, you have impact investors, you have DFIs like USAID, now DFC, you have philanthropic capital, you have family office capital. All of these we would broadly bucket as financial institutions. Now, each one of these, based on who the promoters are behind, have a risk time horizon and a return threshold that they need to meet, which will then indicate to them into which sectors, into which countries, into which assets that they should be investing in. What we're seeing increasingly today is an understanding that the world has really changed from an asset allocation perspective. There's a huge momentum, like a few forces happening worldwide right now. One is on the climate. So we've got the COP26 happening right now, and there are trillions of dollars being allocated towards climate change and climate mitigation. There is also a huge movement towards impact financing. Again, trillions of dollars are pouring into impact financing in the various different understandings of what impact financing is. And as Kenya and East Africa, I think we're one of the very blessed because we have a very high incidence of impact financiers in our markets. And this is helping us to catalyze that long-term patient capital, which is difficult by its very nature. And I think which KEPFIC and a few others we will talk about during this panel, the examples of mobilizing this patient capital. But I think Kenya, together with USAID and KIM, we have the building blocks, proof points, enough proof points to mobilize even more of this long-term patient capital across the different pools that I mentioned.
Thank you, Neha. Ruben, is there anything you'd like to add? And maybe Geoffrey?
Okay. So for us, and I'll speak to the experience of Dry Associates in particular, since our specialty is in corporate debt, we've found that some of the challenges we have, at least in raising that patient capital, especially from a local perspective, is you find investors locally are somewhat skittish, especially given the experience that they've had in the past with defaults. So typically for us is now convincing them again to wade back into the waters, that there are these worthwhile opportunities for that are being provided by other companies that have opportunities for growth that they want to access, that this opportunity is worth it, and this isn't going to be an experience that's going to be as similar as the other ones perhaps that have gone south. So for us, one of our big challenges is actually convincing investors that this is actually worth it. And we are actually glad. There's a silver lining to that cloud in that it's enabled us to actually innovate and actually create those structures that make sure that we can actually secure at least the confidence of local investors when it comes to raising that patient capital for these companies to actually grow.
Thank you. Geoffrey, do you have anything to
add? Just to add on to the comments of my colleagues, just looking at what's been happening in the market locally over the last 12 months, we've seen a number of new issuances come up around the long-term assets, and I'm quite obviously keen. And a couple of years ago, through the initiatives of the Capital Markets Authority, they set up the framework for the real estate investment trusts, and that sort of stumbled a bit, even with the first issuances about 2015. But I think as investor knowledge, understanding, improved structuring comes through, and you're now having more case studies. I think we've now seen the REITs market come back a bit more strongly. We've seen Aecon come with issuances, and a couple more firms are also now looking keenly at that space. So it tells me that the market is evolving, and now if you look at property, is such a big asset class. Yeah, it's a long-term asset You're now seeing that we are beginning to structure the property market correctly in terms of making it accessible to the mass retail market through a listed vehicle. The other one which also caught my eye was Centum issued zero coupon bonds to support their real estate development projects, which typically take call it a 2 to 3 year horizon. So by going that particular route, then you're not under the cash flow pressure as you build to be able to have to honor the interest payments, whether it's on a quarterly or semi-annual period. So I can see that the market is evolving, and advisors are coming up with products which are really in tandem with what the client is looking for, in tandem with the client's business, so that this whole concept of matching, to me, it's now coming right to the fore. And I think it means that we're headed in the right direction as a market. And also just to mention finally, and I think Nia mentioned about it, I think we also saw the green bond, I think at the beginning of last year. And again, that opens up people's minds that this is possible, and you don't necessarily only have to list it in Kenya, you can also look at an offshore listing. So there's obviously a lot more optionality in terms of financing coming into the market, and we are seeing local companies actually going out and being able to raise the money. The deals are difficult, but they're getting done. Thank you.
Thank you. Thank you all for those insights. So I think, and you've all alluded to the role business advisory service providers, such as yourselves, who are very experienced in this, can play to unlock that long-term finance. So with reference to the work that you do, and I know you've talked a little bit about it, what would you tell firms, organizations out there who are struggling to raise long-term capital and they do not know how to go about it? They are probably borrowing short-term and they get caught up because they're not able to achieve what it is they want to do. So what would you tell them regarding business advisory services, such as what you offer, that it can be done? So what would you advise organizations that are looking for long-term capital in reference to business advisory services that you provide in your funds? Yes, okay. Geoffrey, go first.
Okay, thank you. I think the whole process of capital raising it's not an easy process because at the end of the day, someone is required to write a check, and that person has a fiduciary responsibility to the money, to the owners of the capital that they manage. It's therefore very important that you prepare as well as you possibly can to be able to meet and face these investors and persuade them of the merits of your investment opportunity. The key fundamentals of why one would invest in one entity vis-a-vis another do not really change. You must be able to have a compelling investment story, which is well articulated, which people can understand, with a good competitive advantage in the long term. You need to have a good management team, and you need to show track record that would give investors confidence. It doesn't mean that if you're a startup, investors wouldn't have, but they look even to the past of the individuals behind the company to be able to see whether they give them the comfort that they know what they're doing and what they're looking for. I think you need to package your story properly. And it's also best to probably choose just one or two advisors. At times I find companies, entrepreneurs want to have 10 advisors marketing the same deal, and it just becomes messy and confusing. It's also good to speak to the regulators early, especially if you're thinking about going to the capital markets framework, so that you have a good understanding, and go out there to conferences about finance. And I think now it's become very easy with, you don't have to go travel physically, because a lot of these conferences are now available virtually, capital raising 101, and participate in that. But it's critical to get a transaction advisor who has real experience in putting together transactions to to be able to hold your hand and walk you down that path.
Thank you.
Thank you.
Niha, do you have anything to add?
I think Jeff covered quite a lot of it, but to SMEs who are looking to, or even companies, larger companies who are looking to raise patient capital, I think it's two sides of a coin. One is also the pool of patient capital being available, and the second is that your project or your company has to be investable, so investor ready. So I think I'll just try and address both sides of the coin because they're equally important. You can't raise money if there's no patient capital available, and if there's patient capital available but there's no investable projects, it just wouldn't work. So in terms of, just to add to Jeff's points on what does it take if the patient capital was available, like what would it take for you to raise it? Just in addition to some of his points, one very critical element is governance. You need to make sure that every shilling is accounted for. And governance is not just financial governance, it's governance across, depending on which sector you are. So if you're in manufacturing, you have to make sure that your environmental health and safety governance is up to scratch. You need to make sure that your tax records with KRA are up to scratch. So governance and due diligence has to be, and as you think about fundraising, you should be aware that this will be called upon. So start preparing your company or your business or your books to make sure that it is ready for due diligence, and you have that governance structure in place. You don't need to hire a very large board. You can have an advisory board. It's just the intention of a governance structure signals a lot to capital providers. Then in addition to also understanding that raising patient capital, if this is the first time you're raising any sort of capital, whether it's debt or equity, the chances of you raising like a 10-year debt loan or a 10-year equity investment is quite low. So take it in stages. Get the first short-term capital, understand what it means to take on board third-party capital, bring it into your ecosystem within the business, and then evolve to getting to that patient capital. But have the ambition that you can grow your business and the hope that you will get patient capital. It's being done. On the other side of the coin is how do we attract that patient capital? How do we put together that patient capital? And I think Jeff alluded to the Acorn Green Bond. They also have a REIT. The beauty of a REIT is that it's in the capital markets. The beauty of a bond is that it's in the capital markets, and therefore anyone who is investing in the capital markets can dip in, dip out. It's available for the long term. But what allowed them to do that was a complex blended structure aligning different pools of capital with different risk appetites to then make it possible for you and me to invest in the bond. So there is a lot of structuring that will happen if you want patient capital into your businesses. And that's where a trusted advisor who's done this before is really, really important.
Ruben?
Thank you for that. Thank you for the question. When it comes to raising money, especially with BASPs, such as their associates, back to that. So when it comes to raising money with BASPs, I think it's important for SMEs and entrepreneurs to know that the service is not inaccessible. We aren't sitting in an ivory tower. We're not sitting somewhere far and just looking at your business as a set of numbers. We actually want to know who you are as the owner. We want to know what your vision is and what your long-term plans and how your idea came to be and how you plan to execute and carry it out in future. So we go beyond just being a provider of third-party money or third-party capital for whatever time horizon into your business, but we're typically partners who want to sit with you and walk through the process of raising money with you, at least with the goal of actually seeing you succeed. because we say your success as a business person is also the success of our investors. So beyond just the structuring and the placement and the looking for money and the due diligence, we're actually there to walk you through the process to help you achieve success. And in that process, we're also going to achieve success as business advisory service providers. Whether we're looking at your business with the goal of making it investor ready, or whether you're already investor ready and we're actually just looking for a place to place money for you.
Thank you. Thank you, panelists. I want us to take a pause at this point and hand it back to Hassan. I know our audience are asking a lot, Yusuf, sorry, they're asking a lot of questions and would like to answer those questions. So over to you, Yusuf.
Thank you very much, Paris. Of course, we have quite a number of questions coming in from our audiences online. The first one is, he has not mentioned his name. That is he's saying to the advisory service providers in the panel, your services seem very useful to businesses. I would like to know the costs associated with such services. Maybe they're not affordable to normal SMEs. Paris, if you can allow me to take just one more. Mulua from Makueni is asking, why has it been difficult for financial institutions to do long-term lending? You want me to add one more? Or you can tackle the two first? Okay.
Okay, so about the cost, I'm sure you'll have something to say about that. Starting with Ruben.
Thank you for the question. So with us, if it's about cost, we at least want to assure whoever's at home who's tweeting that we only get paid when we succeed, right? And before we succeed, before we actually carry out our due diligence and review of the opportunities that you've actually put before us, I think it's also good for SME owners and potential entrepreneurs to know that you never walk out of an engagement or any discussion with a BASP, you either leave with one of two things. If you don't leave with money, at least leave with advice. And one will serve you for a definite time horizon because the investor is going to want their money back after 5 years. But the second will serve you opportunity after opportunity after opportunity. So we always say, even though the BASP might not be able to secure funding or get you the deal that you were looking for, they will definitely give you advice because of their knowledge in the industry to actually help you on your journey forward. And even though you might not get something going with them at the time, you'll still create opportunities for future engagement. So if it doesn't happen now, it's definitely going to happen later if you're persistent. And if you don't leave with money, leave with advice because it's just as valuable. And then for us, since we place corporate debt, we only get paid when you succeed, especially as dry associates. Thank you.
Thank you, Ruben. Neha?
So for us, it's similar to dry associates. We get paid on success. So if you win, we win. It's also quite a risky business model for BASPs to undertake because it's very time consuming. The length of time it'll take to get debt or equity ranges from 3 months to even longer than 12 months. And it's a lot of time for the firm to put behind. So one of the initial discussions we would have with SMEs is preparation, is this something we are willing to take on board? And in that first conversation, which Ruben alluded to, you would be going through, is this business fundraisable? And if it isn't, or if there isn't a kind of meeting of chemistry, it's very important that you really get on and there's a strong relationship with your trusted advisor because you're going to be working with them for a very long time. If for whatever reason in that first meeting, if there is no kind of meeting of minds, you will walk away from the reasons why, for example, we think that the business isn't ready for investors right now, but could be ready in the future. These are the things you would need to do. or if we accept it, then we have a degree of confidence that we're putting our risk and time and resources behind this because we're confident that we're going to be able to fundraise for you. Yeah.
Thanks. Geoffrey?
Our model is certainly slightly different from Dry and Niha's farm because we like there for someone to also have some skin in the game. And so we do have an expectation of some work fees. We're flexible around the work fees. We could even do it on a milestone basis. But we carry a lot of scars of battle where you've done a lot of work and the client basically has very limited investment. So what's the incentive to push the deal to completion? So we find, but the fees are fair, and again, I don't think one would disagree with a client about that, but I just find a deal on pure risk is pretty risky and one that personally we wouldn't take that model. But we can't disagree about the fees, and we're also sensitive to what the companies can pay, and you'll be amazed when the client pays you. I think he also expects you to do a lot more because he's feeling the pain at every milestone. So that drives you to be able to achieve completion. On the issue of long-term lending, I think this is very much a function of the source of funds that a particular institution is managing. So if you look at it, because banking is probably the best known financial institution here locally, most banks predominantly have short-term monies in terms of deposits. Easily 70% of the funding available to the bank is deposits. And so you typically find, even internationally, banks typically don't lend more than 10 years. They'd go out till maybe about 7 years. But if you're doing a project like, say, a power project where maybe you have a 15-year power tariff agreement, then maybe you'd find DFIs are a better source for that long-term funding. You'd find that the banks may not be able to provide that. So it's very much dependent on the mandate. If you look at the institution Ngatia is leading, KEPFIC, will be very good because the pension funds, depending on also the scheme, if the scheme has a lot of younger employees with maybe a longer period before they retire, they may be more willing to take longer term exposure. But if you have a scheme which has predominantly aging workforce, especially if you look at the old defined benefit scheme, many of them may not want to come into the KEPFIC product. So again, it's very much a question of looking at the age of your underlying customer base and the investment horizon that they have. So as long as you're able to address that, then you're able to find the long-term funding.
Thank you. Thank you. So I think we'll now go to your closing remarks. I think we have heard from yourselves about a lot of innovations around the long-term finance market. We've heard about the REITs, which are fairly new in our Kenyan market, the bonds, of course, the commercial paper. And from your experience, I mean, you've all had a considerable amount of exposure outside of the country, outside of this continent. What other innovations do you see in this market, coming to our market, as your closing remarks? I'll start with Niha, ladies first.
So about a week and a half ago, one of the world's largest and probably best performing venture capital funds, Sequoia, announced a complete shake-up of their particular industry, in the sense that they moved from a closed-ended term life fund to an open-ended fund. And what that means is that if you think back to what venture capitalists do, they invest in startups and then grow them up to the IPO stage. By them shifting this capital structure from a fixed life fund to an open-ended fund, it allows them to redeploy capital from one investment again into another investment or into the same investment all the way from seed stage to IPO and even beyond. So it's created for itself a permanent capital vehicle, a permanent patient capital vehicle. Now, this is unheard of in the venture capital industry, and it is something that everyone is talking about. It's a game changer. Entrepreneurs are going to be attracted to take money from someone like Sequoia because of the advantages of this long-term capital. We're seeing in the different kind of investor communities, a lot of discussion around this. We have DFIs who traditionally are providers of capital to fund managers locally, to SMEs locally, also thinking through this structure and seeing, how can they be more patient? They already are patient, but how can they be more patient? Because there is a need and a demand for that kind of capital. So these are some of the innovations happening outside, which we are already seeing trickling into our markets.
Thank you, Neha. Ruben?
Okay. So I guess in closing, as dry associates, we'll just go off of our experience with Watu Credit. So there's been, with regards to innovation, there's been a lot of talk here about how you can use technology to actually reach the end consumer or to reduce the cost of providing your service or product to the end consumer. But there's scarcely been any talk about how you can also use technology to create a solution that actually makes your company or SME more palatable to an investor. So what I'm trying to say is, in the case of a company like Watu Credit, the founders started off in microfinance. So they were their business before Watu was giving cheap loans to women's groups at the coast in Kwale County so that they could buy water tanks or buy sewing machines or get at least small businesses started so that they could employ themselves. But the founders then went around asking questions to every single person who was riding a motorcycle. They say to them, how much are you paying every week to the owner who owns your motorcycle? So they realized there's a provider of capital, the owner of the motorcycle, and there's a user of the capital, the guy who's riding. And they noticed the guy was paying 5,000 shillings a week. And they said, how can we create a solution where we make this motorcycle affordable for him? So essentially, they asked themselves, how can we find a way of lending to him against which he can afford this motorcycle at essentially 2,000 shillings a week? And that's how Watu Credit was born, by working out the back end. A solution that started from the end user paying at least 500 shillings a day for his motorcycle to now a company that has a book of 12 billion shillings plus off of creating a solution off of the person. So now, when you have to price that 500 shillings a day for the motorcycle, you now have to create the technological solutions around it to make sure that he can effectively pay you that 500 shillings a day, so that you also have to work that into your collections and your loan origination and your processing systems, to where the ordinary person on the street who was neglected before by a bank because he didn't have collateral, he has an M-Pesa statement. He has an M-Pesa account that has money coming in and money coming out. How can we lend to him against that and the associated CRB certificate that comes off of that? So you find the Watu team now built a solution that allowed them to collect these small amounts of 500 shillings a day, to the extent to where now they have so much liquidity they do 200 million shillings plus in collections a week. And that's actually made the company more investor friendly by creating the kind of investment solution that the asset side, which is the incoming loans from Watu, are so liquid, they pay out 200 million shillings a week, maybe 600 to 800 a month. While the liability side, which is the money that's due to the investor, is coming back every quarter. So that's an example of how a company now can use technology in how it creates solutions that are affordable to the end consumer, especially someone at the bottom of the pyramid, to actually make something that works not just for the end consumer, but for the investor. And what we're seeing, at least on the innovation side, is there's plenty of companies in Kenya who are actually now taking that model of taking big patient money and doling it out as loans to smaller size consumers who can actually afford to pay more for it. So one of those is technology isn't just useful for creating an end solution to reach your clients cheaply. It can also be useful in creating the kind of solution that makes your business more palatable or more attractive to investors. The other thing we're also seeing is, especially from our case study with Watu Credit, is that then our commercial paper essentially becomes the vehicle for which you can invest in the life of a boda boda, or you can actually create increasing livelihoods for people around the country. So what we're most excited for as Dry Associates to see is, in the long run, that there are a lot of companies that are coming out who have worked out this business model just by walking the ground and living the lives of the ordinary people to actually create solutions that work not just for consumers but for investors as well.
Thank you, Ruben.
Thank you.
And finally, Geoffrey.
Thank you. I think my perspective is, looking at it, especially from a local investor side, is we certainly need to do a lot more work in terms of creating formal investment vehicles with varying mandates so that we can be able to offer customers a wider choice of places where they can put in their funds, and that these new investment vehicles would have a lot more optionality in terms of where they can invest. I think we've seen, especially the CMA has taken a strong role in terms of driving product innovation. But you find the product innovation and regulation comes up, but then the investor side lags behind. So if someone wants to bring a product to market, but is not certain about the uptake, and at times, for you to get some of the internationals to come, it's very challenging, either because of size issues, or at a time if someone is new into this market and there's a lot of political noise, so people hold back. But you see, the local capital is already exposed to the local environment. And so for me, I think we as intermediaries have a big task ahead to be able to create different investment vehicles and to be able to attract funding so that an entity like KEPFIC needs to be replicated across different other verticals so that it's much easier for us to make investment decisions. There's certainly a lot of money in this country, but it's sort of tied up in assets that are not yielding enough, and everyone is speculating on land. But I think we need to change that asset allocation, and I think it will be predominantly driven by people who are already on the ground. So I see that as being an important milestone from our country, even from a capital formation point of view. Thank you.
Thank you, Geoffrey. And now let's turn to hear what Mr. Ngatia had to say in his closing remarks.
In the near term. And right now we are speaking to various players in the market, and if any of you are interested in finding or tapping. So KEPFIC is looking to do a lot in the near future. I'm not even going to talk too far out. I mentioned that we have an investment target of about $250 million in the near term. And right now we are speaking to various players in the market, and if any of you are interested in finding or tapping the pension fund community for financing for infrastructure projects, we welcome those projects. We're looking at regional. We're not just looking at Nairobi. We're looking across the country, and we're looking to grow our membership significantly. Right now, we have about 27 members with approximately $5.5 billion under management in total, and about 10% of that can get into infrastructure opportunities as per investment regulations. So you can think of us as having $550 million which we can deploy today. But that all depends on having the right projects in place. So this is a call for proposals, a call for applications, a call for projects for us to take a look at. In the future, what we would love to do is as we progress on this journey, is to co-invest with pension schemes from other regions that are looking to invest in Kenyan opportunities. There is more than enough space for not just local investors, but also for international investors. And it's something that we're very excited about. But it's important to reiterate here that KEPFIC is not a fund manager. We're an association. We're bringing our members together and working with their fund managers on these opportunities.
Thank you very much. I want to thank you so much, our panelists, together with Mr. Ngatia, who was not here today. I've got some key takeaways from this session, that we are yet to see more innovations in the long-term capital market arena. What is happening is just the tip of the iceberg. But also, I hear that we need a supportive or a very facilitative regulatory environment to allow those innovations to thrive. Thank you very much. We really appreciate you. And you're welcome to come back again. Thank you.
Paris, thank you very much, Geoffrey, Niha, as well as Ruben Mabishi for that discussion. And ladies and gentlemen, we are at the telltale end of today's event, and there's no way we can end this discussion without the remarks of someone very important when it comes to matters finance. She's none other than Lorraine Rawlings. She's the Director, Economic Growth, Finance and Investment Portfolio, Palladium. She's going to sum up all the day's highlight and basically give us her closing remarks. Lorraine.
Thank you. I'm happy to highlight a few of today's particularly salient lessons. First, I'd like to thank our guests. Our keynote speaker, Lawrence Nzunga, Makwene County Minister for Trade, Industry, Marketing, Tourism, and Cooperative Development. Clearly a very busy man. Ronald Inyangala, Manager of the National Treasury's Credit Guarantee Scheme. Elizabeth Asichi, Acting CEO of the Kakamega County Investment and Development Agency, and all of the Kim partners who have joined us as panelists, so thank you. As you may recall, the Kenya Investment Mechanism works with a network of partners, including business advisory service providers, or BASPs. Ngatia Kirungi of KEPFIC has described a good advisor as a bridge between businesses and sources of capital. Ruben from Dry Associates, as well as Ngatia, both cautioned patience during prolonged capital raising engagements. However, BASPs like Dry Associates, Genghis Capital, and Materi Capital support that ongoing engagement. They also instill confidence and structure deals. And as our Chief of Party, Roger Bird, has put so aptly, BASPs have specialized expertise in shaping transactions and in communicating in language that financial institutions understand. We also heard from financial institutions lending to smallholders and other generally underserved groups. Githunguri Dairy Cooperative SACCO, Crescent Takaful SACCO, and Equity Debt Solutions are focused on clients generally excluded from formal financing arrangements. And the specialization of GDC and EDS enabled them to rapidly innovate new products to respond to disease outbreak that was devastating some of their clients. So staying close to those clients and being specialized in that segment was particularly helpful for rapid response when that was required. However, large national banks also have a role to play here. Kenya Commercial Bank's large branch network and agent banking network enables them to meet people where they are. And in this work, KCB has also seen the importance of in-person interaction and capacity building to reach communities that are often wary of banking. We've also heard a lot about the promise of digital financial services for meeting underserved communities and extending the reach of the financial services industry. Charles Kyoko told us about GDC's experience implementing digital financial services products, and he highlighted the critical role of partnerships, of working with IT companies and telecom companies, but also the importance of collaboration and what he called co-opetition within the financial services industry. But we know the private sector can't go it alone. We were reminded of the importance of national and county government engagement and support for unlocking private investment. At every level, government can shape policies and rules that create a hospitable or inhospitable business environment. On this topic, Elizabeth Asichi spoke to the importance of broad consultation in developing policies. Similarly, McQueeney County worked with a variety of experts and stakeholders in the public and private sectors when restructuring ownership of a county government-owned processing plant. And to quote Lawrence Nzunga, county governments need to send a strong message to investors that businesses can operate smoothly. Governments also drive investment through financial risk sharing and incentive schemes. The MSME Credit Guarantee Scheme, which nudges banks to lend to SMEs on more favorable terms, is a fantastic example. And county governments can support strategic ecosystem actors, such as those focused on value addition, as is being done by the Kakamega County Investment Development Agency. Today's speakers also touched on the importance of diversified capital sources for financing sectors and projects which, due to size, timeline, risk perception, or other factors, usually aren't fit for typical bank financing. For instance, we heard during the KEPFIC presentation that activating pension funds as investors provides a source of capital with long time horizons that is an especially good fit for things like infrastructure investment, which also have long time horizons. Patient capital, as Neha from Materi Capital stressed, allows companies to innovate and build for long-term value. On the other hand, we heard that Watu Credit meets its clients' needs using micropayments. Finally, and perhaps most importantly, and at least inspiring for me, many of our really impressive partners shared with us that often the things they tried first did not go so well, but it was their ability and willingness to reflect, review, and adapt that brought them success. So I hope all of you have learned as much as I did today and are excited about integrating some of these lessons into your own investments, into your own business, and into your own day-to-day work. We'd like to, again, thank you to all the guest speakers and thank you for the audience joining us today. And we hope you will join us tomorrow to hear how healthy ecosystems support investment in MSMEs and a topic especially close to my heart, investing in women. Thank you. Back to you, Seth.
Thank you very much, Lauren, for that. We really appreciate that. Now, before we wrap up, something very, very important. And this is something very dear to Kenya Investment Mechanism because it's going to come in handy as far as, you know, planning for the next learning session is concerned. So we have a few evaluation questions for you. So before you leave, please, make sure you answer some of the questions that we've raised there in the chat box. For example, we will want to know what was the most valuable thing you learned today. That is going to really help the Kenya Investment Mechanism team to even make the next session better. Please provide your rating for today's sessions. We had two, remember, one by Anne and one by Paris. Maybe how relevant was today's session to your work. Feel free to add any comment and observation that you've had from the two sessions today. Now, ladies and gentlemen, we're about to announce the poll. I'm sure most of you will want to hear. We did ask you earlier, are financial institutions innovating to serve all market system? We did ask you whether financial institutions are innovating to serve all market system. And the results is a tie. Very interesting observation there. Now, before I leave you, I'm going to leave you with some of the things that are going to come up tomorrow as far as tomorrow's discussion is concerned. And here is what to expect come Thursday. Bye-bye for now, and enjoy the rest of your evening.